session. Any questions? Yes. Any questions?
So I have one. If you can just explain ultra wires just briefly.
Okay. Um, Now, there are certain provisions given by the Articles of Association of a company. So, when the initial shareholders are drafting the Articles of Association, they will include sections in the article says what are the authorities that the directors can exercise or what are their responsibilities, their maximum duties as well as their responsibilities and their rights, and the scope of the work defined from that objective. You can't go beyond the objectives of the organization. So if the company is formed for sorry importation, you can't do exports. So always the board of directors must perform within the given objectives of the company or given authority of the company. So if the directors are performing their duties within the given authority as well as within the given objectives, we call that as intravirus. Intra, within. Intra means within the given authority. Right? If the directors are exercising their authority which are not given by the articles or exceeding their authority, those are called ultra-virus transactions. You have gone beyond. Intra means within, ultra means gone beyond. So from a bank's perspective, um, now the argument of the bankers, since the objective clause is no more there, right? Now earlier there were these articles of association, you had two parts, memorandum and articles of association, right? Memorandum will include all the objectives of the company where the directors have to fulfill the objectives. And the articles of association will talk about the directors, their performance, their shareholders' rights, everything. How to conduct the AGM and how to voting, everything. Now with this 7 of 2007 Companies Act, they remove this memorandum part. Why they intentionally did that? They wanted to remove the objectives. Now, for an example, under the previous Companies Act, if you have formed the company for to do imports, you can't do exports, right? So if you want to do exports, you have to amend your articles and get the shareholders' consent and amend the articles and proceed. So the point was there was a since it's time to time you had to go back to the shareholders and get in their consent is little bit time consuming. So new when the experts decided when they are forming the new Companies Act 7 of 2007 to remove this objective clause. So today if you form a company, you can do any business or legal business, but if you have to take any license, special license for you to proceed. Now for an example, if you want to do leasing, you have to get the special license. If you want to do insurance, you have to get special license. Other than that, if you form a company today, you can do any business. So the argument of the bankers, since the objective clause is no more there, now there is no requirement of obtaining intravirus certificate. Intravirus certificate was previously taken to get a confirmation from the directors that they have not exceeded their authority. Now, because of this new rule, now the banks are not taking this intravirus certificate. What they say is that since the objectives are not there is no requirement to obtain the intravirus certificate. But the concern is where, though you don't have the memorandum, if you want, you can have objectives, right? The objective clause is not there under the memorandum, but if you want any objectives, you can include that in the articles of association. So rather than assuming that the company doesn't have any objectives, better you go through the articles and see whether there are any specific objectives, and if so, it's advisable to obtain the intravirus certificate rather than straight away saying no, there is no requirement of obtaining intravirus certificates. So simply answering your question, what is intravirus is within the given authority. Exceeding the authority is ultravirus. So from a bank's point of view, we don't know whether they are working within the given authority or whether they are exceeding. That is why we take the intravenous certificate. Is it
Thank you, sir.
okay? Anything else? Any questions? You're from which bank, Christine? Christine, you're from which bank?
This is Alison. I think I logged in from a different, my husband's
Ah,
account.
okay,
That's why.
okay, okay. I was wondering, I was looking whether you're a new student. Okay, right. Any other questions? Okay, no questions. Right. Now, last week I stopped here, types of shares. Now, you get different types of companies will have different types of shares. Ordinary shares, preference shares, deferred shares, non-voting shares, redeemable shares. Now, ordinary shares means any company at the point of opening, initially issuing shares, they can, or forming a company, they can issue shares. Those are called ordinary shares. So one of the main key features of an ordinary share is to they have the voting rights. So any ordinary shareholder will have the voting right. What I heard was now from Monday onwards there is a right issue. Um, Prime Lands, they are going to list their company and the share price is 10 rupees and 40 cents. So I don't know whether it seems to be out of the construction companies or this land estate companies. This Prime Land is a good type of a company. But today I think the markets have gone down. But if anyone who is interested, just see whether you it's an opportunity for you all to invest. I'm not investing, I have to tell you that. Otherwise you might think that I'm also investing. No, I'm not investing. But out of the land sales businesses, the Prime Land is acceptable type of average type of a company who are catering to the middle or high end as well, but majority for the middle earning people. So definitely their market is in time to come. Definitely it will grow. So with that, their profits might go up. Currently, I think their profits are a little bit low. But so just see if you have excess money and if you think that's keeping money in a savings account is not worth this, investing in Prime Land listing would be ideal. So just it's a call. I just share the information. I can't recommend anything because I have to. You all have to go through and you have to get a recommendation from the broker as well. But I just show you there is an opportunity currently, whether it's a very good opportunity or average opportunity is I don't know. But from a company's point of view, I prefer if I'm purchasing a land from a land sales, I prefer to purchase from Prime Land, not any other land sales. So I have that comfort. I have not done with them. I have not previously done any transactions, but it seems to be they are a little bit more customer oriented, and their buildings even looks like that they are reaching the customer requirements. Not so high rising type of buildings. And I'm not marketing. I don't have any relationship or any connections. I'm just talking what is available in the market, right? So the preference shares give preferential right rank above the ordinary shares, get the right to preferential dividend. Normally, an ordinary shareholder will get a dividend. What do you mean by a dividend? What is a dividend? Yes. What do you mean by a dividend? Come on, these bankers, dude. You're trying to say that you don't know dividend. Salinda, what is dividend? Salinda.
It's a part of profit.
Yeah, it's a return on investment, right? You invest and the company must give a return. Now it's a return given to the shareholders. Shareholders invest over the company. Now company must give some return. It's a return given to the shareholders. So that's simply it's your return on your investment. If you go and keep your money in a bank account, bank will pay you a deposit interest. So similarly, this is also something to that effect. This is the return on investment. So if you want to keep the shareholders happy, you have to give a good rate by way of a dividend or a good dividend. Otherwise, the shareholders will sell their shares and move out. Especially now, for an example, if you have invested 1 billion, 1B in a company, and if the company is not going to pay a single cent, you will wonder why what is this, and you will try to sell the shares and move out. Because if you go and keep in a normal bank deposit, you will get 2% today. So the fixed deposit rates are very low. 1 year is around 4 to 5, and so still you will get that rate. And if you go and purchase shares of a company, if you're not getting a single cent, you will not keep that share. You will sell that share and move out. So in an ordinary shareholders, they are entitled for a dividend, but the concern is where there is no assurance that they will get the dividend, because it's sometimes if the company is doing well only, the company will issue give a dividend. If the company is not doing well, they will not give a single they will not give a dividend. So now when you come to preference shareholders, normally preference shareholders will get a preference over an ordinary shareholder. So for an example, if the preference shareholders, if the company has agreed to give 1 rupee per share each year, if sometimes there can be a situation where the company is not paying a dividend for the ordinary shareholders, but they will have to pay a dividend for the preference shareholders, 1 rupee per share. But in case if they can't pay that particular dividend this year, this 1 year 1 rupee per share will accumulate it for the next year. So if the next year, if the company is going to pay a dividend, definitely they will have to pay 2 rupees, not 1 rupee, because this year's dividend was accumulated today, next year. So that's the preference that they get than an ordinary shareholder. So the company can, if they want, they can issue preference shareholders as well. But for a company to pay a dividend, they have to meet the solvency test requirement. So from a banker's perspective, if you are dealing with companies, if the company says that we are going to pay a dividend, you will have to ask the question from them whether you all have met the solvency test requirement. At the same time, if you are taking a company as a customer, please make sure that you need to study their share pattern. What type of shares are there, whether it's ordinary or preference shares. If you see that there are preference shares in their shareholdings, you have to check and see how much they have agreed to pay as dividend, because it can be an alarming thing. Sometimes they agree a huge amount as for preference shareholders. So it can be preference shareholders are coming from outside the country and they are taking money out. So you all have to be careful. I don't know whether the bankers are checking all these requirements, but bankers' normal understanding, as I told you last week, bankers think when you have companies, it's less problem. No, it is not the case. The most difficult and most stringent type of rules are restrictions. Sorry, most high risk customers are the companies, because one thing, the knowledge over the bankers are less with regard to the companies, and top of that, you think that companies are regulated by the Companies Act or listed entities are regulated by the stock exchange. You don't have to be careful. No, you have to still be careful. Behind the law, these companies can do anything. Right? I'm 100% sure. Majority of the companies who are holding accounts with you all have to, if you don't take extra precautionary actions against their behavior, understanding their behavior, you will have a lot of problems, right? Because not like a sole proprietorship or a partnership, company directors are not liable for the debts. So then if something goes wrong, you will lose the money. Okay. So the main difference between ordinary and preference shareholders, ordinary shareholders, uh, they are entitled for a dividend, but there's no assurance of a dividend. Preference shareholders, they are entitled, and even their payment will be accumulated to the next year. So that's the main difference between ordinary and preference shareholders. Deferred shares with limited rights get the right to income or profit after ordinary shares. So deferred shareholders are lower than the ordinary. You can be a deferred shareholder, but there's no assurance after you pay anything for the ordinary shareholders only, you are going to get the priority. Non-voting shares, most of the companies, they issue non-voting shares. Um, if you see HNB, Commercial, NTB, Ceylon, Pan Asia, all those banks have issued non-voting shares. So you get voting as well as non-voting. The difference is where non-voting shareholders will not get the authority right to vote at annual general meeting. So there can be a situation where the company want capital, but uh, existing shareholders will not like to issue shares and dilute their percentages. Now, if you take, if you study your structures, your organization structure, shareholder structure, you will see there are top 100. They are holding almost 70% of the shares, right? And they don't want to dilute their percentages by merely issuing shares, right? If a company, if the bank or the financial institution or the company is going to issue shares continuously, they have to uh, purchase those shares for them to maintain their shareholding, right? If they don't exercise their rights by purchasing shares, their rights will be get diluted. Their shareholdings will get diluted. So to avoid that, sometimes the companies they issue non-voting shares. So you have two categories, voting and non-voting. Non-voting shareholders don't have the right to vote at the annual general meetings. Redeemable shares as created on the understanding that they will be bought buyback by the company, a way of increasing capital. Now, after you issue the shares for a certain period and you get the money and you do what you want out of the money, and after a certain period you buy back those shares and pay to the shareholders, right? Now if you see the debenture issues, um, those debentures, in case if the company, sorry, in case if the financial institution, especially this applicable for the financial institutions, debentures, if the financial institution goes on bankruptcy, all these debentures will be converted into shares. So redeemable means you redeem, right, after the period, after the period what you wanted. After that, you are going to buy the shares and pay back the shareholders. And during that particular period, if there are any entitled dividend, you will have to pay dividends for them. Right. Any questions on these types of shareholders or shares? Yes. Right. Pricing of shares. Shares must now be issued for consideration which the board of directors resolves in fair and reasonable to the company and to all the existing shareholders. Now, those days, when the companies are going for a share issue, what they did was they decided, okay, uh, uh, nominal value is 10 rupees, and if they are selling at 15 rupees, they decided, okay, 15 rupees is 5 rupees is going to be the premium. Anything premium is anything about the nominal value. So then they sold the shares as 15 rupees. Now with the new Companies Act 7 of 2007, now you don't have these premium accounts. Straight away, the board of directors will have to take a decision at which price they are going to sell the shares. And based on accountancy evaluations, they decide, okay, we are going to sell a share 50 rupees each. So whatever the money that you are going to get out of issuing shares to the public, is called as the stated capital. Now today you don't have this minimum value, nominal values or share premiums. So straight away it's the stated capital. Okay. So the directors can take the call how they are going to price it. Sometimes if you don't have the expertise within the board, you can get the auditors consent as well. Right. Procedure to increase stated capital. I think this is important for you all to understand. Now, sometimes you request customers to increase their commitment, their shareholders' money. So at that time, normally what you say is, okay, you need to increase your contribution and issue more shares and then bring it to us. We will consider your facility. So this procedure of increasing stated capital is important. Now, then they might ask how to do that, right? So let's say you have to call for a shareholders meeting, and it should be extraordinary general meeting. There are two types of meetings: annual general meetings and extraordinary general meetings. Annual general meeting is a meeting annually held by all the companies registered under the Companies Act. Extraordinary general meeting is something exceptional. Other than the annual general meetings, you can have the extraordinary general meeting, right? So then, um, so you have to get the shareholders' approval at an annual general meeting. Sorry, extraordinary general meeting. Sorry. Once you get the approval, then you have to do the rest of the action. This at the board meeting, so the board of directors will take the allocation process. Once the pricing is done, it has to be forwarded to the Inland Revenue to calculate the stamp duty. They will recheck the pricing. Payment must done within the month. So stamp duty, they will decide the price of the share based on your accounting calculations, and they will see whether the pricing stamp duty is in order. With the payment slip, must register the required documents at the RC once the issue is completed, along with the tax payment or the tax payment receipts. You have to file it at the register of companies. So then you can get the form 6 to show that you have increased the stated capital of the company. So I have seen sometimes the banks, they request the companies to increase the stated capital, but as the banker you should be able to advise them to say, okay, this is the procedure, this is how we have to do. Normally the articles of association will include the entire process. So request them to follow the procedure, and the company secretaries will have to do that job. And then um, in line with the requirements, once the form 6 is registered at the register of companies, only we can officially accept that the company has increased the stated capital. So stated capital, as I told you, is the contribution of the company share owners. Uh, so definitely the banks will request them, at least you bring 40%, we will give 60%. So the 40-60 rule will apply in most of the time. You have to pay 40, or the banks will pay 40. Sorry, banks will pay 60 if your contribution is 40. But banks will not give you loans if the shareholders' contribution is just 10%, and the banks will not give 90%. So more you have contributed, more chances are there that you will try to protect your organization. Less contribution, less chances are there for you to protect the institution. So that's the logic behind this. And always the banks, they want to ensure that your contribution is high than what we give. For an example, if you are requesting a bank to give a loan 1 billion, the bank will say, okay, you bring 600 million. So if you have pumped 600 million, I think the bank is safe because you have to protect your 600 million. So if so, you will protect our money as well, 1 billion. So that's the logic that goes behind this principle. And banks, time to time, they request shareholders to increase their stated capital based on the commitment. Okay, any other questions? Any questions? Definitely, I'll have to have a lot of questions because this is an area that normally uh, not tested at any forum. Even I doubt whether your inside training sessions are conducted on this kind of detailed type of company law requirements. Because what you think is, as I told you, if you're dealing with a company, you're safe. No, that is not the case. That's what I'm teaching, explaining you all is the most important requirement for your day-to-day activities. So it's important for you to raise questions and clear all your doubts. I can finish these slides, that's not a problem. But what I want is to address your problems and we can share a lot of information among us and I also can learn from you all. So what are the practical problems that you all face when you are handling companies? Yes, can someone tell me what are the practical issues that you face when you're dealing with companies? Anthony, what are the practical problems that you face? Yes, Anthony?
Yeah, sorry, sir, I do not have experience in that side because I'm not attached to branch banking.
Okay, right. What about Bandara? What are your practical experience? Bandara?
So no experience related to companies. I'm attached to banking, but not much experience related to
Branch
this.
banking, and if you're not dealing with companies.
Yeah.
Okay. Chaturanga? Chaturanga? What are your practical?
Sir, actually, sir, I am also not so much experienced in that side. Then as NSB, we are not much dealing with company.
You're not dealing with companies, right? Okay. Dennis, what about you? Dennis? Dennis? Dennis, what is your experience for companies? Gayan, what about you? I will I will come back to Dennis. Gayan, what is your view? What is your practice? What are the practical issues that you face when you are dealing with companies? Gayan? Gayan Fernando. There are two Gayans. One is Madhushankar and Gayan Fernando. I'm talking to Gayan Fernando.
No, sir, I don't have any kind of that kind of practice with the
What is your
companies.
area? What is your area?
I do loan recoveries.
So still you are dealing with companies, no?
No, we have to, most of the time we have to deal with personal loans.
Okay, right. Gayan Madhushankar? Gayan Madhushankar? Gayan Madhushankar? Great Lanka? Is this Great Lanka? What is your experience? Kaushalya, what is your experience? What type of experience or practical difficulties you face when you're dealing with companies? Kaushalya? Kaushalya, I'm calling you. Yes? Yes, Madhushankar? Sorry, Kaushalya? You have on your mic, but you're not. I can't hear anything. Madushka, Madushka. Salinda, what are your practical experience that you see when you're dealing with companies? Salinda, Sampath.
Sir, can you hear me?
Yeah, what are the practical problems that you have when you're dealing with
Usually, when you're dealing with there are when getting documents, that's the practical issue we are having.
Okay.
It is difficult to get them correct documents in the account opening or when changes are happening.
Okay, so
They are not
what is your approach?
sometimes quite
කමක්
difficult,
නැහැ
but
කියලා ඔහොම
in
ඉන්නවද? කමක් නැහැ ප්‍රශ්නයක් නැහැ කම්පැනි එකක් කියලා ගන්න නැතුව ඉන්නවද? ඒකද ප්‍රශ්නේ.
නෑ කොහොම try කරලා ගන්න sir. So that's the problem we are having in most of the cases. In most of cases, they do not have that required documents. In the case of even the opening documents, opening the accounts, some banks I they don't know. They are saying that they are not required. Like such, for example, shareholding percentage now Form A and B now central bank has imposed us. So they are not
Form
familiar with
50.
those.
Form 50.
Yeah, shareholders, individual share, no, individual and the companies, they are requesting shareholder details, no.
Uh,
So yeah,
ultimate.
ultimate beneficial ownership, yes. So when he want that documents recently, they they didn't have much idea of this. They said that some other banks are not requesting those documents. So we are facing some problems with regard to those
Yeah,
kind of things.
that's a normal answer given by the customers when they come. They will come to you and say the other bank is not asking, right?
Yeah,
Then they will go to that bank and say that you all are not asking.
yeah,
Okay,
that's
so the simple argument, if you're not, if you're asking, if that other bank is not asking, why can't they go there? Why are they coming behind you? So that's a common thing. Now, normally, sometimes they go up to the extent to say that the board of directors have taken a decision uh, to not to get this particular document. So those are, you don't have to worry if the other bank is not doing, there'll be
yeah,
a penalty for that, right?
yeah.
So that's an area you don't you have to take it. Okay.
Sometimes they have bank accounts at all banks.
Yeah.
Most of the banks still they are saying like that.
Okay. Okay. Thank you,
Okay, sir.
Sampath, for
Okay,
answering.
sir.
Thank you.
Oh, okay.
Thank you. Sandhya, what is your experience? Sandhya, Sandhya, what are your experience over the companies?
Yes, sir.
Yeah.
May
What are you?
may I know whether the company can change the objective of article of association with the same company name, sir?
Can they can do?
How can I check it, sir?
So you have to see whether there are any amendments to the articles, and if there are amendments, that has to be incorporated into the existing articles to say that they have done a change. And at the top of that, any changes you can get certified copies from the register of companies. So if the company has included a new objective which are not there in the old one, you can request a company to give us updated articles of association. Then once they give the articles, you can cross check with the register of companies whether they have done this change. So through a certified copy issued by the register of companies, you can check that.
Okay, thank you.
Right. Any particular scenario that you're talking, or any issue that you all faced? Because this is the first time that I'm getting this kind of a question from an audience. Have you come across any concerns, any issues with regard to the article where they have changed their objectives? Is it a specific question or just to know? Yes, Sandhya?
Just to know, sir.
Okay, right. Shan, what are your experience?
Sir, I have small question, sir.
Yes, Ampan.
When you change that objectives, do they have to inform the register company register, right?
Yeah, definitely, because
And
it's a
then
change.
once they change do they give any document that
No,
they have changed?
all the changes will be filed at the register of companies. So
Okay,
you have to you have to ensure that you are dealing with an updated type of articles of association. So it's your
okay.
responsibility. So if there's any change, that's the responsibility of the company to inform you all that there was a change.
Uh-huh. So how do we know get that? How do we ensure that they have informed to the company register? It should be certified by that company secretary. Is it okay?
That's the
Oh.
KYC of you and your company. That's what I told you. When you are dealing with companies, you should know your KYC should be very strong. Any
Mhm.
changes officially, they have to inform you all, and any out of you, they have to give evidence as well. So once they change, they will have to register at the register of companies, and you can request them to bring a certified copy from that.
Oh, okay, sir. Thank you.
Right. um, Tivanka, what are your experience that you see? And when you are registering, please register a name that I can call your, right? Otherwise it's very difficult for me to I look at the screen and I am calling. Tivanka, what are your experience that you have?
Yeah, so I think because I'm not more into handling the companies, but I have a question like when it comes to payments, so there can be like internally like getting approvals, and so the payment must be done within a 1 month. So I think like my point of view is like there might be some delays of getting the payment
What type of payments that you're talking here to get within a 1 month period?
regarding the stated capital. Uh,
Yeah. Okay, that's a stamp duty payment. Once you get the tax clearance from the Inland Revenue, you have to complete that within a stipulated period. So because the next month your calculations, your accounts, your value of share will change. So if the share has increased, then once again the tax amount will be little bit high. So that's the whole idea. That doesn't mean that you can't. For an example, you took the tax. Uh, Clearance letter or tax amount letter this month, and all of a sudden COVID, you couldn't proceed. So you are taking that decision to change the articles or increase the stated capital in 6 months time. So once again at that time you have to go, because whatever the opinion that you have received for tax payment is old. So once again you go to the Inland Revenue and show your accounts and the books, and based on the book value of a share, they will decide what is the new tax amount that you have to pay. So that's not a problem actually. But what they say is normally they say that uh, their opinion will be valid only for a period of 1 month, and you have to, if you are doing it within that particular year, you have to do that. So it's not a restriction. It's just to ensure that you are paying the correct tax in line with the current value. Okay, right. Tangaraja, what's your experience?
So I don't have any experience because I'm an undergraduate, sir.
Okay, so right. Okay, Udesha, yes.
Udesha, sir.
Udesha, sorry, yes. What's your
Uh,
experience?
I usually handle, I'm into the operation side, like lease and loans. So once if the corporate facility comes, once it like the file get the facility file get approved by the credit department, what we check is the BR and the any like the directors form 20 if they are changing addresses of like the director changes. So then we proceed with the file. So mainly that is what we do in corporate facilities. Once the facility gets approved by the credit department, we handle the operation side of the facility.
That's the disbursing part and the filing.
Yes.
Okay. Now, when you are checking, do you obtain the certified copy from the register of companies or certified copies from the company secretary?
The thing is, like it all comes under like not the original ones, but
Yeah.
then we do sign a resolution from the company with the embossed seal, like to get the like the signatories are either the two directors or director's secretary.
Yeah. Yeah. The
Yeah.
concern is, yeah, the company will sign anything, right? But you have to make sure that you are dealing with the correct document. Now, for an example, if you are taking a 20 checking the directors list, right? If you want to ensure that these directors are right, you have to get a certified copy from the register of companies. Now, for an example, if I'm a company secretary, I can give you a extra document form 20 to say ABC directors were included into this particular company, was appointed on this particular date. So whatever the document, what I have given, it's there. But I can avoid registering that at the register of companies. So registrar's books are not updated, whereas I have issued a certified copy to say this is original, this is a copy of the form 20. So please make sure that if you are dealing with companies, always the copy should come from the register of companies by way of a certified copy, because sometimes you are dealing with a company where those directors are not there, and you will create a loan and you will disperse, but then all of a sudden you will realize these directors are not there, right? And the other directors might say, look here, why did you give this loan? These directors are not with us. The company secretary has done a transaction without our knowledge, so we are not going to pay. So that's a mistake what I see. Banks, they heavily rely on, I'm talking about the majority of the banks, they use this practice. They rely on the resolution what they get. Who should sign this resolution? The board decision of the company? Yes, Desha, what's your experience? Who should sign? You told that
Uh,
you're taking a resolution, right? Who should sign that resolution? What is the requirement?
like to authorize the signatories, like they are working like intraviders, like they work within the authority,
Mhm. Who should sign the
either
document?
either two directors or director or a secretary of the company secretary.
Okay, common seal, is it a must?
Yes,
Yeah.
we usually
Normally,
take the comments.
yeah, it should be one of the most important requirement. It should be original letterhead. You can't get
Yes,
a,
under the company's letterhead. Yes.
yeah, original letterhead, not a photocopy, right?
Yeah.
And clearly the requirement should be specifically stated. For an example, on such and such a day, the board of directors was of XY Private Limited decided to open an account with X Bank, this branch, right? So then they will say these are the signatories, and it was resolved at the board meeting held on this particular date. So this common seal is not a must, okay? But two directors or director and secretary should sign. Normally, a company secretary can issue a extract. There is no requirement for two parties to sign, but all banks, as a practice, they insist on two parties signature, director and secretary or two directors. So just to know, at least two people know about this transaction. But you'll have to be very careful. This form 20, it just to be certified by the register of companies, and based on that only it should be a recently issued one. And don't take old documents. Now, if the document is a certified copy is issued by the register of companies in 2015, I think it's outdated. Even 2019, it's outdated. So always you all have to have a standard within the company, within how many, what is the range of a certificate. If it is 1 month, 2 months, 3 months, so overnight you can change your people, right? Most recent, which is if your KYC is very good, you can accept the old one, but my advice is not to do that, especially if you are giving a huge loan, anything above 50 million, anything above 25 million. It's good for your officers to go and do a check at the register of companies to make sure that these people are existing in that company, because they can do anything. They can create a situation and they can create an account and they can say that we are this company and it's another account of that company, and all of a sudden new 3 directors can come as signatories of that company. You will grant a facility for that company and they will take the money and they will vanish. So you all have to be very careful on the handling companies, because through companies you can have a lot of issues. Okay, be careful. Right. Ziad, what are your experience?
Ms. Anaratna, what I feel is that corporate clients are very demanding. That's what I can say.
That's the nature of the
Other than
corporate
that,
clients.
Mr. Anaratna, yeah, I mean, the moment we get a request, they think, okay, they are superior. We have to stop all our work and attend their work only. That's the issue that,
Yeah.
I mean, that's
But
the experience I'm having.
yeah, I know.
Yeah.
I can understand. That's the normal nature, and they are not profitable also. Corporate customers are not profitable customers unless they have a good turnover.
Yes,
Yeah.
yeah, exactly. They are very rate sensitive as well. They are very rate sensitive. They will negotiate rates saying that, okay, that bank offers this much. Why are you offering us such a high rate? This can you please at least reduce the rate? And they want everything in a rush. They definitely change just the SOP of the bank also according to the way they want.
Yeah. So the point is where now sometimes it will be difficult for you to ask for this updated form 20s and everything because they are so demanding. But you can send one of your officers to the register of companies and do a search at your cost.
Yeah, it's like this.
Right?
Yeah, it's around like this. Mainly in where I work, usually the legal officer deals with it. As a officer
Okay.
as corporate banking, I did not what do you call deal with what is secret documents and stuff. What happens is, Mr. Ratna, I go to the client, collect them, and then I hand it over to the legal officer. And then if there's any lackings or any documents are missing, usually they communicate to each other. If not, the legal officer will inform the RM. From RM, I will go and collect the documents.
Okay. Okay. Point taken. Right. So you have a control where the legal officers are handling
Getting
that
involved,
particular
yes.
part. Yeah. So, but still, I
Yes,
think as bank officers, you all have to make sure sometimes a legal officer might miss that point, because most of the current generation, they are not bothered about, they are not, I don't know the reason that they don't go into deep and they study. But the issue is where when you come to companies, the certified copies issued by the register of companies is a must. Right, so sometimes they might. Mic is on. Yeah, yeah. I mean, just okay, right? So yeah, a little bit careful on that aspect, because finally, if something happens, it's going to happen to your organization, not maybe that your ex has done that or I have done, but collectively, if you can contribute on that, I think that's great, because the amount of risk that you all are taking from companies is very high. Right, so finally, it should not be affected badly for your company, because technically there can be a lot of gaps in your documentation if you don't get the proper document. So that is the concern that I have. I have. So a little bit careful on that aspect. Right. Good. Thank you very much for those who gave inputs with regard to their practical issues. And anyone else that want to give your feedback?
Let me add one, sir.
Yeah. Yeah.
Some corporates tend to delay in submitting their annual report.
Okay.
And
Submitted.
plus,
So okay, then now there are two types of companies. No, some companies, their financial year ends start from 1st Jan to 31st December. So normally, as a practice, they can have their annual general meeting 30th June, prior to 30th June, right? So there is another category where they are financial year that goes with the tax year. 1st of April to 31st March. So those companies, they can have the annual general meeting up to September 30th. So 6 months from the closing of their financial accounts. But the banks, they are a little bit more different type of approach. They normally, their financial year is 31st December, but they hold their annual general meetings prior to 31st of March. There are two main reasons what I have seen. Now it has been the norm as well, a practice. Top of that, the banks who are going for these competitions, they have to publish, they have to complete the annual general meeting before 31st March. So maybe one reason where that what you say is that you're used for a structure where your annual reports are published by mid-March, whereas the other companies, their annual reports come sometimes mid-June or mid-September. So it depends on their annual, the tax year, right? So that may be the reason, but annual report is not a must, I would say. But there are certain requirements that has to be published among the shareholders in line with the Companies Act. So if they are preparing annual report or a piece of document to say it's an annual report in line with the articles or in line with the Companies Act requirement, you can't expect all the companies to have an annual report less like your company, because it's we go beyond the requirement, and sometimes our documents are more than 1 or 2 kilos. So whereas a small company can have just few pages which are mandatory requirements, but in case of a listed entity, even the listed entity, they can have a condensed version and they can have a small document. But what you said is right. Some companies, sometimes they might delay in the sense it might be because their financial year is different. Is that the reason, Shan, or anything else that you are experiencing over your companies?
No, some tend to delay submitting audited accounts. More than they took nearly 9 months to 1 year to submit audited accounts. But we request the management accounts from them, but we get the official audited reports. It
Financial
takes nearly financial reports. It takes nearly 9 months to 12 months.
Yeah, because you want to complete your ratings, right?
Yes.
Yeah. So that's normally what happens, because one reason may be that they don't want to show the correct taxes, right? So they prepare the management accounts and they get the facilities, but they don't want to show the financial accounts. So if you see the outcome of the financial accounting and the management accounting, two different figures. So it's a common problem, I think, that all the banks are having, collecting their audited financial accounts, because sometimes they intentionally they delay, they don't want to pay the taxes, especially now quarter, all companies, they have to pay their taxes as personal as well. April, year ending April, they have to pay by September 30th or October, I can't remember, there's a date. So that may be that they don't want to show their transaction at that time, or they want to skip that particular period, or sometimes towards the tax payment dates, they try to prepare the accounts, or they want to shift the quarter to the next quarter. So your year is ending 31st April, you want to shift that to the May transaction. Those may be, I know that there's a practical issue of collecting this audited financials, because they intentionally they delayed, so you can't comply the requirements imposed by the risk department when you don't get the financial rating and financial reports for you to assess the risk of those customers. Yes. Anything else? Anyone want to add something? Good. No. Right. Good.
Sir,
Yeah. Yes,
sir, I have question with regard to that certified documents. Once the documents are certified by the company secretary, is it okay to proceed, or should we go to the company register and check if these are correct? That liability doesn't that go to company secretary?
No.
If they have signed their own documents or that which are not correct.
it depends on the reputation of the company, right? If it is a reputed company and the company secretary wanted to maintain his reputation as well, they will not sign for the things which they have not done. But if you feel that this company is not stable and they are just surviving in the business, my advice is always I insist, even for a small company, you have to get the certified copies from the register of companies. So especially this company secretary is an outsourced employee in most of the companies. So they work for a fee, and sometimes without their knowledge, they can place their signature to get that particular fee. So sometimes it may be a wrong information where the company has given to the company secretary. So I don't think that you all, as reputed banks, you should act on based on the information given by the company secretary. So once again, it goes with the KYC and the reputation of that company. If it is a big company, okay. If it is a financial institution, we say a big giant company, you don't have to worry. You can just rely, but it goes with the KYC as well, right? But for the unknown companies, small companies where the company secretary is outsourced, I don't recommend that. Okay.
Okay, sir. Okay, so the thing is, the in the new companies act, the director can be the secretary also, no? Sir?
If the company's turnover is less, annual turnover is less than 1 million, any director can be a company secretary. So annual turnover 1 million means it's a small amount, right?
Yes.
So if they say, okay, our annual turnover is less than 1 million, I don't think that they have to have a company for that. It's better you have a small petty for that purpose. Anything above that, you have to have a company secretary.
So how do we ensure that they have less? How do we know that they have less than 1 million turnover?
Yeah, so then if you see that one of the directors are a company secretary, you
Uh-huh.
have to request the company to say, give a declaration saying that since we don't have a company secretary because our turnover is less than 1 million. And also at the same time, if you are the banker, you can go through their bank statements and see what is their turnover. No?
Yes.
So that's a common sense. Yeah.
The if they are company secretaries should be approved by that Register General of Companies, no?
Register of
So they
companies must approve, but there is a, as I told you, if the turnover is less than 1 million, any director can act because they are not more specific on the secretary's role there because it's a small company. So there are a lot of they can leniency is there for them to run the business, right?
that they are not checking those turnovers. Is that yes?
No, I don't think they will do that. It's you all have to do that actually, bankers.
Oh, okay. So only from our accounts we can check, no, that the turnovers and if
Yeah,
they are
so
you give.
for an example, if they say you can go through your accounts and you know the crib, right? So you can get some information from the crib, and if you see they have borrowed from other financial institution, and as the banker, you can request them to bring the other bank accounts as well. So before you grant a facility, you can say, we want to see the other bank accounts. So now just imagine a turnover of 1 million per a year means you divide it by 12 and see it's around 85,000 turnover. I'm not talking about the profit, right? This is turnover.
Yeah. Yes.
85,000 turnover for a month. I don't think there will be any business in that nature who has formed a company and opened a bank account. It can be a sole proprietorship where your turnover is 85,000 per a month, and where it's a small type of business. But I don't think that the company who is having less than turnover will form a company and open a bank account and 2-3 accounts maintain and facilities. So it practically it can't be, no. To see
Yes.
common sense aspect.
Yes.
Okay.
Okay.
So be
Okay, sir.
careful.
Okay, sir. Sir, other thing is, in case of preference shares,
Yeah.
If the company if the company declares to can the company declare only to give the preference shares holders the dividends? It is not possible, no?
No. Preference, no. It depends on if the ordinary shareholders has agreed to give preference shareholders, they can do. But ordinary shareholders, there is no assurance each year they will get based on the profits. But once you agree with the preference shareholders, they are entitled for that, right? So if on a particular year, if you are not going to pay, you have to pay on the subsequent year. So simply what your question is, whether the preference shareholders will get where the other shareholders will not get. Yes, it can happen. It's
So they
possible.
can accumulate also, no?
They
If you
can
want.
accumulate. They can accumulate also.
Okay, sir. Thank you.
It depends on the terms what you have agreed with the preference shareholders. Okay.
Okay, sir. Okay.
Right. Good. Now share split is you're splitting your shares into small pieces. Now in the recent past you saw a lot of companies did that. Now even Sampath Bank also went for a share split. Any one share we split it into 3 shares. The reason was that our share was around 200 plus, right? So we wanted and more investors to invest. Now for an example, if you want to purchase a share, you have to spend 200 rupees, whereas if once you split into 3, get amount will get adjusted around 60, then more people can afford. So there is no benefit for the company, right? Once you split the shares, number of shares will get doubled or triple, and it's good for the people who are trading shares, buying and selling. So earlier you were able to purchase only 1 share out of 200. Today you can buy 3 shares. So then your ultimate ownership of the number of shares will be high, but percentage wise it's the same. So it will create more liquid position of your share in the market. More people will get the more opportunity for the shareholders to purchase. I will take an example. Earlier, before the split, we had only 24,000 not shareholders. After the split, the shareholding went up to 30,000 not. It's not fixed, it's variable. But you can see how now people are buying more shares because they can afford. Earlier, if you are buying only 25 shares, now today you can buy 75 shares or more than that, right? So that's the whole idea of splitting your shares into small pieces, big share into small pieces, and which you will giving an opportunity for the shareholders to invest in that company. Right, that's the whole process. It's possible, but you have to have provisions in your articles, and you have to go for a shareholders extraordinary general meeting. And once the shareholders approve at the extraordinary general meeting only, there is a process. Once at the annual general meeting, they have to approve, and after the approval, there is a process of splitting these shares. Shares will not get traded for 3 working days, and after that there's a cooling off type of a period, and after that only it will, after you get split, the shares will trade. So this is an opportunity for the investors to invest. There's no benefit for the company. Recently there were a lot of companies who went for this split, share splits. Distribution is a payment out from the company. Most common distribution what we know is the dividend. So in order to pay a dividend, because money moves out, so this payment of dividends, companies, they use 2 approaches. One is the paying cash. So money will go from their book or payout, or instead of paying cash, they will issue shares, right? So that's a way that where you don't have to pay any money out from the company, because only the shares will increase and there is no payout from the company. So it's you can save money within the company during especially a cash dividend is very costly, in the sense you have to find money and the money will move out. But scrip dividend will not create any outflow from the company. But for a distribution, any distribution, the one what you know is the dividend. You have to have, there is a mechanism, right? So from the bank's point of view, you all have to make sure that if the company is going for a dividend payment or any distribution, any payout from the company, it has to be sanctioned by the shareholders. You need to get the approval of the shareholders. And before that, you have to ensure that you meet the solvency test requirement. Solvency test is where your total assets should be more than your total liabilities and the stated capital. Simply, and in a layman's language, once you pay your dividend, your company should be able to continue running the business. That's the whole idea of a solvency. Either you are solvent, or if you are insolvent, you are not supposed to pay a dividend, because once your money move out, if you can't live day to day, it's going to be a problem. So to avoid that situation, they always say, okay, um, uh, you need to meet the solvency test requirement. Once you meet the solvency test requirement only, you can pay dividend out. Okay. Distribution, its impact on the bank. Before the distribution, the company has to obtain the solvency test requirement, which I told you. And if the distribution has been made and the company does not satisfy the solvency test, the distribution may be generally recovered by the company from the shareholders or from the directors who agreed for that. So sometimes you might, if the directors have paid a dividend without proper solvency, the register of companies can take action to and get that money back from the shareholders and the directors. So the directors are very careful on that aspect. They don't want to take a chance. Before you pay your dividend, the solvency, you can have your own solvency and auditor's solvency. So best would be to get the auditor's solvency before you pay, and to make sure that you have taken all the precautionary actions before you pay a dividend. Any questions? Alison, are there any experience as you are working for the chairman, and do you have come across of these terms, or is it something new?
Terms, yes, sir. But not day to day, like not real experience. I've known the concept of it and I've heard it, but I've not got any shareholders like.
Okay. You know the terms, but you have not come across how application of those terms.
Yes.
Yes. Okay. Right. Distribution, what we can do, available options. After the distribution, company has to inform the bank. So from a company's point of view, if there's a distribution after the distribution, they have to inform you. Company has to forward a certified copy of the solvency test from the auditors. So if you are dealing with companies, make sure that you get a copy of the auditor's solvency after the distribution, right? You have the right to request, because if you are dealing, you might say, okay, that's good to pay a dividend, but if the auditor's solvency is not met, sometimes the owners who are foreigners, they have taken the money out. So be careful on that aspect. I know that most of the banks are not requesting for this auditor solvency of their companies. So because the companies are demanding, companies may be demanding, but still you have to have the documentation side as well. Sometimes they might go and complain your managing director, sometimes to the chairman, or maybe that let them go and complain. But if you have done your job properly, but make sure that what you are requesting is right. What I have seen is sometimes the bankers, they request without a reason. So then the customer get confused and they get mad. So don't do that. If you are requesting a document, make sure, ask the question, why I'm asking this question? Why I want this document? Because the customers, they have plenty of reasons. They might say, look here, that X bank is not asking, you're asking. So ask him, okay, you go and get things from that particular bank. We don't have that practice. So make sure as bankers, you have to deal based on the size of your bank. If you're a small bank, I know that you might think you don't have to go up to or deal as a big bank. because your nature is small. What the central bank says is they give exceptions for small banks, but they don't give exceptions for big bank because you are too big to fail. But any transactions that if you are a big bank, you should not do the small transaction. බොහොම සරලව කියනවා නම් සිංහලෙන් කියනවා නම් සිල්ලර බිස්නස් කරන්න එපා. තමන්ගේ බැංකුවේ සයිස් එකට හරියන විදිය බිස්නස් කරන්න පුරුදු වෙන්න. That's the challenge, right? Because what will happen if you go for this small type of business, which the small banks are canvassing, you are in deep trouble. Because sometimes the small banks are not requesting. And if a customer comes and say, okay, this bank is not requesting, just see whether what is the size of the bank, whether it's a small one or a big bank. Right? If they say it's small, if you realize it's a small bank, that's obvious because they don't want those documents. But if you're a big bank, compare with another big bank and see whether they are asking for that document. If they are asking, yes, you have to. Whether they ask or not, if it is a requirement, you have to ask. That's how you have to maintain your status when you come to banking industry. Don't dilute your the quality. Don't dilute the good name of your organization. You have to ensure that you get the correct required stuff, because if something goes wrong, you will have to write for the audit comments. No one will be there. Make sure that you are in line with your directives, especially when you are dealing with companies, especially when you come to money laundering rules and regulations. Be careful. Right. Repurchase. Yes.
Excuse me. How do you differentiate the big bank and small banks according to the assets base? So, what is the basics?
There is no so-called basis. It's your common sense understanding. Now, if you see, there are systemically important banks, right? There are state banks, two giant banks, People's Bank and Bank of Ceylon. Then you get the second layer, systemically important banks, right? So there are certain other banks who are competing with those banks, right? At the same time, there are small banks. I don't want to name any of those banks, right? It's the business sense that you have, right? If you see now, there are certain banks now because of their size. Now, yesterday I had a chat with one of my good friends with Central Bank. When I told, okay, there was an issue with this particular bank, he was telling, oh, that bank from the day one itself, they are into that kind of situations. So you all, with your experience, you know what are the banks that the approaches, based on their approach, based on their size, based on their profit, based on their reputation, based on their age, right? You should be able to especially when you're comparing, you should be able to compare with a bank which is sizable for your bank, right? And I don't simply, whether you like it or not, there are banks, high-end banks, middle and low. So what I'm trying to say, if you are in the high end or middle, you should not compare your banking transaction, or you should not compete with the small banks which are struggling to survive in this system, right? So that's my point. There is no so-called measurement to say whether this is big or small. That comes with your understanding, that comes with your business sense. So anything that if your company is benchmarking a particular bank, make sure that you deal with your all business transactions should be in line with those benchmark banks, not small companies. Okay, Dennis? I know that
Yes, sir.
my
Okay.
answer may not be 100% perfect, since I have a restriction. I can't quote
Yeah, I know
names
that,
of the
sir.
bank. So that's the business sense that you have to bring. Okay, normally banks, they compare, they benchmark. Why can't you be like this bank? Why can't you be like this bank? So those are the benchmarking bank. Always you have to compare with someone above you. Above in the sense, it can be the profitability, it can be the quality, it can be the size, it can be the age, right? Don't compare you with a junior. So here you you have a certain ranking, whether the regulator has done, whether you all have done, right? In that sequence, always try to compare with someone else. If you're fighting, you have to fight with a senior person, not with a junior person. Okay.
Okay, sir.
Any other questions? Repurchase of all the, so almost all the similar terms are there: repurchase, buyback. So the point is where from a uh, bank's point of view, you, if the company is going for a repurchase of shares, once you repurchase, they will cancel, then their stated capital will be get low, and that clearly shows their contribution will become low. So there has to be a mechanism with you and that particular company to understand their changes. So the KYC is the most important thing. And at the same time, if you have given any facilities, your offer letter should contain statement to say, in case of a repurchase, they have to inform us. In case of a buyback, you all have to inform us. So sometimes they might inform or they will not inform. But finally, you will have to ensure that there are no much changes in that particular company, because especially if they are reducing their stated capital, which you have done all evaluation based on the stated capital and without informing you if they are going to change or reduce, it's going to be a problem. So be careful on that. Normally, to buy back shares, companies can borrow from you all, but you have to see what is the reason why they are going to buy back. Any value addition for that. If so, only you can give the financial assistance. Otherwise, you have to be very careful. Sometimes they borrow from you and they reduce their stated capital, and you wanted to increase their stated capital. Instead of that, they you borrow from you and they reduce it. So be careful on those aspects. Finally, they should inform you. And also, when you are giving facilities, maybe that today's context is such that it's very difficult to lend, and therefore banks might go for different options, but still you have to have a control or the edge over those transactions. Amalgamation. What is an amalgamation? Two or more companies may amalgamate as one company that can form to be one of the amalgamating companies or new company. So there can be two companies amalgamating, both will exist, or there can be one after the amalgamation there is only one company. So what you have to see is amalgamation is acceptable. Normally from an amalgamation, what we say is 1 + 1 becomes 3, right? You get the synergy effect, and it's not 1 + 1 2, you get 3. So you get all plus points, and you can your performance will be high. That's the synergy effects. Always what we say is it's 1 + 1 is 3. And so if you don't want to damage the names of those companies, you can have both companies. And if you want to totally change and you want to have one company, it can be a situation of big companies amalgamating with a small company. And then only the big company will exist, or two large companies are merging each other. So then only the big company, large two companies will be there. So it depends on your expectation and the size of the amalgamation. But finally, why you want to get the amalgamation, why you want an amalgamation, is to make sure that you become more stronger than previously. Maybe that I have money, you have the technology. So I'm going to amalgamate with you and become one. Then we can use my money as well as your knowledge or the technical side and grow big. Amalgamation is an inorganic growth. Organic growth is every year 10 to 15%. Amalgamation, as I told you, 1 + 1 is 3, then it's inorganic. You all of a sudden your profit jumps from 1 million to 3 million. Right? If it is organic, 1 million, 15%, 1 million and 15, sorry, 1,150,000. So here 1 million, after the amalgamation, there is a cost as well, jump to 300%, 1 million into 3 million. So through an amalgamation only you can get this kind of a jump. Otherwise you have to wait for years and years to get this 3%, three times jump. So big companies, what they do is they want to establish their position and they amalgamate all small companies and they become a monopolistic type of a company. Then the no competitors are there, all competitors they have amalgamated, and now only they are, that company is existing. So then they can dictate, they can compete, they can do whatever they want. So that's a big business model. What I see in this entire process, amalgamation. So when the point is where if after the amalgamation, so these guides are important for you to understand the practical aspect of all these activities. Now, once the amalgamation, if the value of the share, if the value of the company is increasing, I think that is positive point for you. But after the amalgamation, now for an example, if they are amalgamating with a high loss-making company, which will reduce the value, it's alarming. It will affect your decision making as well. So the company can take a decision, okay, to merge with a big company or a small company. If the value addition is increasing, it's good for the bank. I think that is a call that you have to encourage them. But there can be situations where sometimes after the amalgamation, their credibility will go down. It will affect your decision making. So in certain instances, we have to be very careful. So what you can do is you have to take an undertaking from the company that they will not amalgamate with another company without your prior written consent. So they will inform where we are going to amalgamate, then you have to study their process, and then you will have to say, okay, is it okay or not? Okay. Right. Any questions?
Sir, excuse me.
Yeah.
A couple of years, we know that the government had intention to amalgamate those 2-3 banks, and they wanted to form a new one. Previous government, actually, not the
current
last one, the
government.
previous one.
Current government, yeah.
Current, yeah, Rajapaksa regime in
Yeah.
2014, 2012. So still that kind of intention, still they maintaining, or now they forget it and ask the bank to go ahead with your own policies and own decisions. What has happened to that decision, sir? The amalgamation policies.
Yeah. One thing I must tell you, I can't make any comments about the politicians' decisions because they don't have a policy. Right? Today's policy, tomorrow they will change. That is why we call them as politicians. So we don't know what the politicians are going to do for this country and for the economic. What I know is now, if I'm taking, I will explain this point from an economical perspective. All our banks' balance sheets are small. Though we say, okay, we are number one, number two, number three, we have big banks, state banks, everything. But if you take the financially, our balance sheets are small. When you have small balance sheet, it's very difficult for you to borrow from other countries because other countries will lend only for the big balance sheets. They don't want to lend for small balance sheets. So that was the main reason during 2014 they requested, and the other reason was there were two requirements. One, they wanted to reduce the finance companies. There were around 50 odd finance companies at that time. They wanted to reduce it to 20 because central bank to control these 50 companies was a big issue, because you know that finance companies sometimes it's very difficult and their practices are totally different from the banks. So one aspect they wanted to reduce it, therefore they requested especially the banks to take over some companies. So if you have a subsidiary company which is in the finance business, some companies they took over those companies. That was one intention. Second intention was to show big balance sheets. That is why they wanted to amalgamate this DFCC and NDB to make it more a big size. So my personal view is that rather than merging DFCC and NDB, because right now they are doing commercial banking, but more at that time more into development banking, rather than combining two development banks, better what they should have done, request a big commercial bank would take, merge with NDB, another big commercial bank to merge with DFCC. Then you have both arms. Then it won't affect the employees of both companies, because the DFCC, now for an example, we'll assume that DFCC and commercial merge each other. DFCC can focus on the development banking side. Now, no harm for the employees, no harm for their growth. It will create a competition, as well as the commercial can concentrate on the commercial banking side. So there was no big rationale for them to merge two development banks. Rather than that, what they should have done was to merge this commercial bank with the development bank and let these two banks go proceed without making any damage for their identity. So that should have been the approach. But subsequently, what happens? They advanced this election, and with that, when the next regime came, nothing happened. But I must take you back to 2005. I can remember at that time, Mr. Ranil Wickremesinghe was the Prime Minister. At that time, he gave a statement to say, this is in 2005, right? And in another 5 years' time, there will be only 5 banks. So this concept was there for a long time, even from 2005 onwards, the opposition. And but it was exercised during this 2014-15, latter part of 2013-14, why they wanted to show big balance sheets. So today I don't know what their expectation, but one thing I can clearly say that if from a country's point of view, from economical point of view, definitely if things are in order, the authorities will go for amalgamation. Less the number of banks we have, it will be easy for them to control. Then we can show big balance sheets, right? And we can borrow more. And from economical point of view, that is the best option for the country. I know it's not good, so sound fast, but from an economical point of view, from the country's point of view, growth point of view, it will be good for the country if you have less number of banks with big balance sheets. So today, tomorrow, I don't know what will happen, what type of decisions the politicians will take, because hardly they take decisions, effective decisions. So, but that is in the long run, that will be there, and more amalgamations will come. So you all have to be get ready for that challenge, because only fit people will survive, fittest will survive, and the odds will thrown out. So if there's an amalgamation, definitely 30% of the employees will lose their jobs from the weak company, right? If you are not fit person, if you are not fit to show that you are a capable person whom I can handle situations, then sometimes you will not be able to, or your employer will say you go home. So that's why I told you you need to ensure that your multi-skilling is important. Especially the banking is a job where when you are inside the bank, you are a giant. But once you move out after your retirement, no demand at all. That's the nature of banking, right? Understand that you might have big giant people when they are inside in the top position, but once they move out, there is no recognition. If you're going to say I'm a retired banker, I don't know whether there is a job opportunity after retirement. So better you have the other skills as well, multi-skilling. Focus on another profession, then at least your experience and your other professional qualifications will help you to find a better place or a good place after your retirement. That's the reality when you come to banking. Yes. Any other questions? Right. So these subsidiary companies are under working for a parent company. So subsidiary means if the parent company is holding more than 50% of the shares, it's a subsidiary of the parent company. So if you are 100% owned subsidiaries, those are called wholly owned subsidiaries. So definitely the banks, they have subsidiaries, right? anything above 51%, if the parent is holding, those are called subsidiaries, right? So the issue is where if there are 100% owned subsidiaries by the parent can without informing the subsidiary, if they want, they can uh, pass a resolution and close down the business. So when you are lending to a subsidiary, 100% owned subsidiary, you all have to be a little bit careful on that aspect. Without your knowledge, the parent company can close down the business. So if you are lending to a subsidiary, it's good for you all to have a corporate guarantee from the parent company. So then the parent has given an undertaking. You will be safe because you can definitely the parent will have to pay you the money or the dues owed by that particular company. So under each and every slide I have given what action you all have to do. So in such an instances, so you have to have a control. So when you're preparing a KYC list for the companies, you need to make sure that you cover all the points which I have stated and make sure that you have a control over those points. Because as you all said, it's very clear they are demanding, they dictate terms, whereas you dictate terms for the small customers, but the big customers dictate terms for you all. So you're in a real soup. It's very difficult to control them. But still, be careful on that aspect. You need to get the control over those companies. Maybe that they are complaining to your board, but finally you should be able to go to the board and say, okay, this is why I took this is why I requested. You had a doubt, and that's the reason. So there is no standard for any of these things, but you need to ensure you get all the required documentation before you proceed with the transaction with the company. Right? Any questions? No?
Sir, could the parent company conduct any audit in subsidiary companies? Are they allowed?
Yeah, it depends on the structure as well. Sometimes the group functions will be available in the parent company. If the group function is there, right, they might send their own audit teams to conduct audits. At the same time, it depends on the size of the subsidiaries as well. If you have a sizable type of a subsidiary, and if you have a subsidiary which is also a regulated entity, they will have to have their own audit. And as an independent audit, your parent company can send the audit team and check whether their transactions are in order. So answering to your question, yes or no, it depends on the size and depends on your organization policy. But advice is to have a control to the parent, because finally, if something goes wrong in a subsidiary, it's not good for the parent's good name. Right? People might say, okay, this is a subsidiary of this company. Now today you see this media is corrupted media. Now we have they publish what is not required and they don't publish what is required. It's very clear. Sorry to say that that's the nature of the public, media, because they want to highlight they don't highlight the most important thing. They want to highlight the political things because they think that they can get a lot of advantage out of that. But I don't know whether people are interested of watching those televisions or channels. So we all have to be very careful because they highlight sometimes in a big way. Okay, this company was affected. This company was. It's true that any company can have anything at any moment. What is the assurance? Yeah, if you take all the companies, there are different intentions. There are people with different intentions. So matching all the intentions at once and delivering stuff is not easy. So any good company, you will get bad apples. If you take EY was a very good audit firm, but there was issue with regard to Lehman Brothers. There was issue with regard to Toshiba. So we can't say that EY is wrong. EY is bad. but it's one of the most leading audit firms today. But the auditor, individual auditor, was the issue. So similarly, you can have concerns, but answering your question, it's good to have your parent to have a control over their subsidiaries. Then if there's any wrong practices, you are doing a independent audit and you will get to know what's really happening in those companies. Yes. Anything else? Any questions?
Also, sir, if there is a group auditor has been appointed, most of the time the parent company chief internal auditor is appointed as a group auditor. Is he have the rights to conduct audits and look over the subsidiaries?
Can if the parent company audit committee says that you are appointed to handle this function as well, yes, you can. Why not? It's finally the subsidiary is under you and they are living out of you. So why not? Why can't you put a restriction? Can. As far as the regulator objections, if there are no objections from the regulator, I think regulators prefer this. Because if a subsidiary is there of a bank and if something happens to a subsidiary, it's not good for the bank as well. So then it's not good for the central bank as well. So they prefer to have this group function, effective group function to run this business. That's a good control for them as well. Yes.
So, if the subsidiaries are listed company in the Colombo Stock Exchange and majority shares are owned by parent company, is it the same?
Yes, it can be the same. That's not a problem. It's an additional control. It's an additional defense line. They are in addition to their own audit. Next will be their independent auditors. In between independent and their own audit, you are having another group audit as well. So there is no problem. So you're adding another defense line to see what's really happening, whether what's happening is in line with the requirements of the expectations of the company. That's okay. That's not a problem. That's perfectly okay. Right. Anything else? Okay. Cross holding is where one director is holding shares of another company. So there can be manipulations when you have too much of directors who are holding cross holdings. So the point is where sometimes they collectively they will take decisions when you're having cross holding. So but finally that kind of structures is also there. Now ranking of claims at the point of liquidation. I told you, now if you're lending against a company asset in order to secure your position at the register of companies, you have to be a secured creditor. So any loan that you give out of a company asset, you have to make sure that you create the charge and you become a secured creditor. So at the point of liquidation, the liquidator will have to liquidate the funds, available funds in the following manner: liquidators payments, EPF, ETF, and gratuity payments, taxes, VAT, stamp duty, debt, debit tax, secured creditors, unsecured creditors, and thereafter only the shareholders will come. So if you have adequate assets, no problem. For an example, if you have 10 million assets and all these liabilities amounting to 10 million, no problem. You can easily liquidate everything and only the shareholders will not get anything. And if you have 20 million assets and 10 million liabilities, all these total into 10 million, once again, no problem. You can settle all these 10 million and the balance 10 million will go to the shareholders. And the problem comes, if you have only 10 million, if you have only 5 million assets and if the liabilities are 10 million, then you will have a problem, right? So 5 million versus 10 million. So you can't pay 10 million because you have only 5 million. So then the priority order based on the priority order only the payments will be distributed. So the danger is where if you take the first 5 up to taxes, if there is an outstanding of 5 million, right, though you are a secured creditor, which is the 6th item, you will not get priority. So that is why when you are lending to a company, make sure that there are no dues. There are no dues with regard to EPF, ETF, gratuity payments, taxes of those companies. So you have to have a control over that. Through your KYC, you will have to ensure that these all the payments are paid on time. No arrears are there, because in case if the assets are less than the liabilities, sometimes you will not be able to recover from that company. Okay, although you have protected as a secured creditor, sometimes you will not be able to get some get the priority. Yeah. Okay, any questions? Okay, now we'll take a break now. 3:15. Okay, come in 25 minutes time. 3:15 by 4 sorry 3:40. Come back and we'll continue. If you have
Sir,
any
is there any,
yeah,
excuse me.
yes,
Sir, is there any tax to be paid at the time of distribution by
Distri-
companies?
distribution I don't think, because it depends on if it's a dividend. Of course dividend
Yeah.
tax is paid by the individual, no, it's not the company. It's based on if you are an individual, if you are getting a dividend. So I think now the dividend tax is waived off from the tax liability. Company, there's no tax. If the company is not paying dividend, there is a tax involved in that. So there were two arguments earlier. Companies were not paying dividend. They said we don't have profits. So then the regulator imposed a rule to say if you're not paying dividend, you have to pay a tax. So at least now, to avoid that particular tax, they pay dividend, because you have to encourage the shareholders to invest more in the company, no? So
Okay.
I don't think the company will have to pay a tax for that, but individual income owners, they will have to pay taxes. But if I'm not mistaken, even the last budget, they told any dividend income will be free of taxes, or sometimes they might add into your total employment and they will charge. So from the company's point of view, you don't have to pay any taxes for dividend.
Thank you, sir.
Okay. This is procedure in to increase stated capital.
Yes, sir.
Yeah. So the point is where now the company has requested, or the bank has requested the. Can you off your mic, please? Right. So the bank, or based on the requirement of the company, when they wanted to increase their capital, it can be by way of a right issue. So you have existing shareholders. Now you want to issue further shares to the existing shareholders. Through that, you are going to bring money and increase the stated capital. So first, the decision have to be taken by the board of directors at a board meeting. And once it is done, they have to go for a public notice. If it is a listed entity, you have to inform to the stock exchange, because it's a price sensitive type of information. Because when you say, okay, we are going for a right issue, every 3 shares you are going to give one, or every 1 share you are going to give one share, one additional share at a cost. So it's a price sensitive type of information. So as soon as you take the decision, you have to inform to the stock exchange if you are a listed entity. So then the next step, you have to call from that particular date, or I can't exactly remember the number of dates, but subsequently, after the publication, you have to go for an extraordinary general meeting to get the shareholders' consent in line with the articles of association of the company. So then you will inform to the once it is approved, then the right issue process will go. So you will have a closing date for the applicants to submit, And once it is closed, right, you will say on a particular day are going to keep open for, there will be a starting date as well as the closing date. Within the closing date, as soon as it's subscribed, you can inform to the stock exchange, and you can, then the next procedure will be allocating those shares. And once those shares are allocated, you have to inform to the stock exchange, and you have to inform to the register of companies as well. So along, as soon as the shares get doubled, or after the split, or sorry, after the after you increase your stated capital, you have to file form number 6 along with this payment of stamp duty and everything, and file that particular form 6 with the register of companies. Then the matter is sorted. So that's how there is a process. First the board approval, then the shareholders approval. In between there'll be stock exchange publications. Then you go for the process. Once it's closed, subscription is closed, and then you have to ensure allocation part, and you have to upload to the stock exchange if it is a listed entity, and publications will be there. And finally, you have to inform to the register of companies with the new shareholdings, and you have to submit a list of shareholdings to the register of companies along with your form 6. That is the process that you have to do. In between that, you have to pay the stamp duty in line with the stamp duty requirements. Anything else, Sampath? Is it clear?
Okay, sir. In case of non-listed companies, other than informing that the stock exchange, other things are the same, right?
Yeah, that's right. All other process, entire process is the same. Only thing that's, since you are a listed entity only, it's a price sensitive information you have to inform to the stock exchange. But the rest of the procedure is the same. All right.
Okay, sir. Thank you. Okay.
Okay. Serious loss of capital. What is a serious loss of capital? Section 222 220 of the New Companies Act provides that if at any time it appears to be a director of a company that the net assets of the company are less than half of its stated capital, he shall inform the board, and the board shall within 20 working days convene an extraordinary general meeting to be held within 40 working days. So if you are going to reduce your capital 50%, serious loss of capital is more than the 50% existing stated capital, it's an alarming type of a situation. You have to inform the board, and immediately board within 21 working days they have to call for the shareholders and inform the shareholders, now there's an issue, okay, what are we going to do, right? So it's a serious loss of situation of a capital, means it's a serious issue for the company as well. So but there are provisions, but these provisions were not there previously. So I have given the steps what they have to do. Just go through those steps. I'm not going to go in detail. Earlier these provisions were not there in the previous Companies Act, but under the current Companies Act all the provisions are there, right? To make sure that the directors will take the responsibility over that. That's why they wanted to include all these sections. Now, there are different types of meetings. Annual general meeting is something annually held. Anything above that are considered as extraordinary general meetings. So it's important at an annual general meeting you have a sequence of events. First, the appointment of directors, or it can be, approving the annual report, approving the financials, approving the dividend, appointment of directors, and approving the auditors, and approving the uh, donations. These are the main 5 activities at annual general meeting. So annually companies must hold their annual general meetings. For small companies, there is no requirement for them to have a physical meeting. If all shareholders have given the consent for them to, without conducting a physical meeting, for them to conduct the annual general meeting, that is acceptable. That's in line with the requirement. So small companies will have little bit flexibility, whereas the big companies you can't have that flexibility. You have to hold the annual general meeting. So the latest addition is where with this COVID situation, companies went for this online AGMs, not physical meetings. Now all the companies, all the banking sector especially, they experience that particular new option, which is a cost saving, but the risk is a little bit high because you are depending on a system, it can be Zoom or it can be Teams, but it's very effective. Uh, from 2020 onwards, the companies went for this online type of uh, annual general meeting. So, and no participation of the shareholders because of the current conditions, the COVID condition. The regulations were issued by the Colombo Stock Exchange how to conduct a online type of AGM. Um, so, like 2019, we were the first to have 100% online type of AGM. So you don't believe the vendor who had discussions with us or who helped in our process. We, each and every task we set with them, and we ensure that it was a successful event. That was his first online type of AGM. After that, during the last 6 months, he has got 120 odd jobs, online meetings uh, from this new opportunity. So you can see how people have got opportunity out of COVID as well. So he's doing well today. It was the first one was ours, and thereafter we have a lot of opportunities for his business. And he told me we got 120 odd uh, businesses annual general meetings thereafter. So that's a good indication. But COVID is not so sounding, right? So extraordinary general meeting, anything special, you have to refer to the shareholders. All these annual general meetings and the extraordinary general meeting both are shareholder meetings. So if you want to take any additional decisions other than the items that I told at the uh, which are taken place at the annual general meeting, you have to call for extraordinary general meeting. And especially for an example, if you want to change the name of the company, if you want to go for a share issue, additional share issue, if you want to go for a debenture issue, you have to call for extraordinary general meeting. And those are in line with the requirements of the company. There is no standard number of meetings when you come to extraordinary general meetings. So it depends on what you want and how you want. Right. Now, proxy is something that you, in your absence, now it's given for the shareholders. Either a shareholder can participate for annual general meeting. In his absence, he can appoint a proxy holder to represent him at the annual general meeting. It's just like a power of attorney. So he can mark the items or whether he is in line with the or whether he's agree or disagree, or he can appoint the proxy to take a decision at the meeting. So it's very important for the companies to or the shareholders to use at least their voting rights through proxies. Now, interest register is another important document where the companies under the new Companies Act, they are compelled to ensure that they have an interest register, right? So all direct information, including their payments, all allowances, everything will be stated in that interest register, and it's a public information. If the shareholders come, uh, all the companies listed entities must show, or not only the listed entity, any company. If it's a public company, you have to show those details to the public, because if they prove that they are shareholders, uh, they they are, they are shareholders of the company, you have to allow them to go through those books and to see what is there in the interest register. Winding up is a process where you close down the business. Winding up can be by court, voluntary winding up under the supervision of the court. So winding up, if the court decided that it's not advisable to continue a business, and the court can take a decision to say, okay, you close down the business. So it can be an illegal business where the court decided not to continue. Voluntary winding up is where you are doing well, you decided to migrate or your entire family decided to migrate, you want to voluntarily settle all the dues and move out. So whatever the winding up, it's a register of company is more concerned whether you can pay all the liabilities. That's the whole idea. That's the whole requirement. So if you can't pay the full liability, they will not allow you to wind up unless the court decided that it's suitable for you to close down the business. Or there can be another winding up under the supervision of the courts. This will happen. It can be a creditor's winding up as well, where the creditors wanted the company to close down the business, and therefore creditors has gone to courts, and the court will appoint a liquidator, and in that particular process, under the supervision of the court, the company will go for a winding up process. So it's the end of the business. Right. So liquidator is the person who will look after the assets and liabilities of the company at the point of liquidation or winding up. So his main responsibility is to ensure that they realize all the assets of the company and pay the liability. So it's a process. He will have to collect all the assets, he will have to realize all the assets, and he will have to pay all liabilities of the company. Anything remaining that he will have to distribute among the shareholders. So the court can appoint a liquidator, or with the creditors they can appoint a liquidator, or at the consent of all the parties they can appoint a suitable person to be the liquidator of the company. So those are the points that I want to highlight when you come to this Companies Act. Any questions? Any questions? Yes.
Sir.
Yeah.
So I have a practical question. When we are facilitating to the corporate customer for a revolving facility, we should have to obtain security documents such as application, receipt, pro note, one by one. For example, we have to grant a STL. We have a package of 100 million package, but they obtain STLs small amounts. So how we the company not the directors not coming to the premises no one by one. So how we obtain these applications documents?
Yeah, the first thing what you have to do is that we have to have a board resolution from the company to say that they have decided to obtain a whatever the loan from X bank amounting to this particular amount, right? So based on their board resolution, then they have to submit their loan application along with the board resolution for you to process. So once you realize, okay, this is a good company, potential company for you to lend, you will go through the in and out of that particular company, financials of that particular company. Then you will have a discussion with them. Then you will see what type of securities that you are going to offer. And thereafter, you will prepare the offer letter. So once you get the approval from your management, you will prepare the offer letter, right? So once you issue the offer letter, if the company agrees on your terms, it may be the repayment, it may be the interest rate, it may be the security and other conditions, they will sign the offer letter. And best would be if they can table the offer letter at the board meeting, and the board must inform that they have tabled this offer letter dated 1st of January 2021 for these facilities, and it should be in the board minutes. And if you can get a board extract from the company that they have approved this facility, and finally they will sign the document and they will forward to you. So once the offer is signed, it can be most probably normally two directors or director and secretary under common seat, and along with that you will request the company to give the other security documentation. So when you come to documentation, we'll say it's a property, company owned asset. So this company owned asset, you have to check the title, and if the title is in order, you will you will get the other additional documents, valuation, original deeds, title report, and inspection report, right? So if all those things are in order, you will execute the mortgage and you will grant the facility. So signing of this mortgage can be by two directors or director and secretary under the common sale. So once the documentation is completed, only you can release the funds. So this is the normal process. What is your deviation? What are you talking? What you want to know from me?
I want to know it's a package, STL package of 100 million. So they not obtain 100 million at once. They take them partly.
Okay.
200, 20 million, 50 million, like wise. So for one for each STL, they have to give us the application receipt or pronote.
No,
or
not necessary. Not necessary. You can approve the full facility. You can have one offer letter. You can have one agreement. Based on the, you can say in that agreement that they will be taking as and when required. But for each and every FAF, when you are releasing the funds, you advisable for you to get a receipt for each and every transaction. So you are considering 100 million loan. Within that there will be sub loans, right? Or else now that is one approach. So you will have one facility, but there will be different stages or different is it different loans or stages you are releasing? Is it
yes,
separate loans?
Separate loans. Separate loans.
So can you identify at the beginning itself how they are going to take this 100 million, or at that time only they are going to take a decision?
No, as when they required, they ask from us.
Yeah. So the point is your offer letter should be very clearly stated that this is a one-time tap with you are giving 100 million limit. Within that there will be sub loans. So now if you are going to take one, best would be if it is separate loans. For each and every loan you can have one offer letter stating that they will be obtaining this in separate loan. For each and every loan you have to have a loan agreement, receipt, and the standing order. That would be because now on a later date, if they default, you should be able to prove that you have granted a loan, there was a loan agreement and receipt and standing order. So if you are going to take one loan application for 100 million, if you are granting as sub loans, it is not advisable. So you can approve as one offer letter, one approval, but you have to clearly state that this will be taken in stages in different by way of different loans. So each and every loan you have to have when the company requests you, we want 20 million, you prepare a it's a sub-limit type of a thing. Under the 100 million you prepare a loan agreement for 20 million. There is no requirement of offer letter because the original offer letter will cover. But if you feel that it's not covered, the original offer letter is not covering, then once again you have to issue a fresh offer letter for that particular 20 million and the receipt 10. So you can have the documentation for 100 million. You don't have to execute mortgages for each and every. You cover 100 million, you get a mortgage for 100 million. Within that, you have to state very clearly in the offer letter that this 100 million will be taken in stages in different loans. So each and every loan you will have a offer loan agreement. Better to have the offer letter for that specific loan because the conditions might change. Initially you agreed to give it at 20%, but when you're giving that particular loan, it can be sometimes 18%. right? So if you are if you are in a, if you are not deviating from the original points what you have agreed, no problem. If you are changing, you have to have a fresh offer letter, loan agreement, offer letter, receipt, and the standing order. But you can have one mortgage. You don't have to go for different mortgages. Okay, is it clear?
Uh, if we add conditions that customer request is considered as an application, and the statement, current account statement as considered as a receipt. Is it okay?
Yeah, the concern is where no, you can, but finally, at the end of the day, if you can prove that you have credited into the customer's account and he has enjoyed, then it's a due. Right? If your original offer letter is very clear on that, then fine. What I want to say is sometimes initially you agreed for 20% and subsequently with regard to these current conditions, the interest rates had changed. Now the point is originally agreed offer letter and this is two different. So sometimes the customers, when they are bad, they will come out with different reasons. They might say, look here, this is a separate loan. This is nothing to do with this. And if you can prove that this is a sublimits or this is small loans which are based on the original offer letter, that's fine. So as soon as it's credited to the customer, and if you can prove that all these small limits are within that limit, fine. But your offer letter, original offer letter should be very strong, and your original loan agreement should be very strong in the sense that everything should be very clear. And also when you are getting the request from the customer, request him to come out with a board resolution stating that we are taking a further 20 million in line with the offer letter approved by the board on the original one. So they are quoting that to say that this 20 million is part of the original loan which was approved on such and such a date for 100 million. So they have committed that. It's a part of that. I think your resolution, the board resolution, what you're going to get from the company, you can cover that part. So if that is there, I think you can create a strong case. But my personal advice, better to have separate offer letters and loan agreements, because since it's a separate loan, because the terms could change from time to time, because when there's a dispute, sometimes it will not be easy for you to justify it. You also don't know at which rate you gave it, especially if the rates are down, fine. If the rates have increased, originally they agreed for 18%, now you are giving at 20%, then you are in trouble. They might say, look, originally we agreed for 18, now we are charging 20, reverse the balance 2%. So it depends on your situation. So if you have not taken documents, offer letter for each and every loan, make sure that you get a resolution from that particular company for you to grant this stage, which is in line with the offer letter dated, the original one, and the loan agreement dated, this one. I think that will cover you. Okay.
So, yeah.
Yes, Dennis.
You told us that you told us consider loan as separate loans, split into separate loans. So, if we got separate loans, do we have to remortgage the property, or a one-time mortgage is enough for that kind of loans?
One-time mortgage, because your original offer letter will clearly state that you are going to take a loan or a limit of 100 million, and this property is going to be a collateral for the entire loan, so sub loans. So you are keeping this as a collateral for the entire full package, and when you are dispersing each and every loan, you are getting an offer letter, loan agreement, and the receipt and the standing order. So you don't have to create new mortgages, small mortgages whenever you are going to disperse a loan part or a separate loan, you in that particular offer letter you are going to say the primary mortgage obtained on this particular date for 100 million. So you are going to consider it as a collateral. You don't have to create separate mortgages. So the one important point, there is no standard for any of these things, right? What is required once you go to courts, if you can prove that you have adequate information, if you have adequate documentation for you to prove that you have granted this loan, and if that party has utilized that, that's it. Right? So if you can prove with whatever the information that you have, you have credited his account and he has enjoyed, that's more than enough. What I told was the best way that then you won't be able to face any practical difficulties, because a good customer will be good if he has money, but that good best customer number one customer will be a bad customer when he don't have money. So at that time he will go for all the options. So then you are in trouble. So as far as if you can prove, yes, this is the package, this is what we got, and we have given each stage where he has given a receipt, no problem, you can prove. So finally the courts always think this is public money. So that's the edge that we have as financial sector. But if the and they are not taking the required documents correctly, then the court will go against the banks. So that is happening at Supreme Court level. Sometimes the bank judgments against the banks are against the banks, because they know the bankers have failed to act due care without negligence. Anything else, Dennis? Is it clear?
No. Yeah. Okay.
So as I told, there is no standard, right? So you all what is required, you should be able to prove your position beyond reasonable doubts. So if you can prove beyond reasonable doubt, based on the balance of probability, you put the evidence into a scale, and if you can prove 51% that you have given this loan and he has enjoyed that particular loan, that's it. You don't have to have only 51%, not 49% maybe with him. You don't have to worry on that. So simply if you have to credit it to his account, and you should be able to prove that he has issued checks from that money. Right? That's more than enough. But all these conditions, loan agreement, offer letters are to make sure that you have followed the formal process. Because that will bring some technical lapses in your process. Right. Any other questions? Good, very good. You're raising your practical problems. That is what I want. Any other questions?
Sir,
Yeah.
sir, excuse me, sir. With regard to that loan, when a company wants to obtain a loan, they have to pass a resolution. No?
Yeah.
When it is approved, also they have to pass a resolution saying that it has been approved and comply with the condition.
No, what I say is normally at the beginning, when they are applying for a loan, they will say, okay, the company on this particular date had decided to obtain a loan from X bank amounted to this 100 million. So that is the original request. They don't know whether you're going to give 100 million or not. They are just requesting as a board decision to say that we wanted 100 million from you. So based on the resolution and all the documentation, you will issue the offer letter to them. Then this offer letter has to be accepted by the board at a board meeting, and to say that board of directors have accepted the offer letter which is issued for 100 million, and now it's in their books, because now they are accepting a specific document. For that, you have to get best would be to get a resolution to that facility as acceptance of the offer letter as well. Then it's confirmed. You know that they have accepted this offer letter at a board meeting. Then the rest of the directors can't say, look here, we were not aware, we don't know. Right? Initially what we wanted a request, now you have given a facility which now we don't want. So there can be problems. So best would be to go for the second resolution along with your offer letter. So then they can't deny any time, because you have a resolution to say they have accepted this offer letter dated 1st of January 2021 for a series of short-term loans, maximum of 100 million against the property at number 12 Gold Road, Colombo 3. That's it. So then they are bound out of that. They can't say, no, we are not responsible. Okay. Anything else?
Okay, sir. Thank you. The thing is, in the interest register, the company secretary, does she records the in the that is related party transaction? Only that too, she is recording that.
Normally interest register they don't have to record, but you have to have a separate set of information with regard to the related parties. Related party in the sense the close relation, yes. Spouse and the dependent children, yes. That information will be there, right? So the spouse details, spouse birth certificate, or sorry, NIC, any accounts, all those information should be there. Related party in the sense close relations, yes. That has to be also there. Sorry, I missed that point.
Okay, sir. Thank you.
What I can see is you're asking a lot of questions. You have a lot of concerns as well. You're passing a part of the problem to me and trying to get clearance. So if in future, don't worry. If you all have any problems, just let me know the case. I'm not going to talk anything in public. That's the whole idea of having discussions here, to know where we have gone wrong. Yesterday, up to yesterday, if you have gone wrong, it's what to do. But tomorrow you have to ensure that you are not going to do any mistakes. So if you can give me the exact situation, anything that you can share in this front of this forum. And also I'm requesting all of you to share whatever the information what we are discussing here only within this forum. To go and talk with to say that bank has they're doing this bank is no. You come to educational platform, it should not be the case. Okay, right. Anything else? Okay, now why corporate governance matters to corporations in general and banks in particular. So why we want this corporate governance for banks? We discussed that we want corporate governance for companies. Now we are a little bit more focused. Why we want for banks? Is there any reason for that? Defining a starting point. What is corporate governance for banks? So the whole idea, now when you come to in general, I'm talking nothing to do with this particular slide. Now I told you banks, they have borrowed from public money, right? So when you are borrowing, can you see the set of slides?
Yes.
Okay, right. So when they when since you all are borrowing from public, your liabilities to the depositors are much more higher than the shareholders' money. So that is why we have two regulators. One is the Companies Act to protect the shareholders, and the articles is there to protect the shareholders, and the regulator to protect the depositors. So always the regulator's rule is up. It's a supreme law. Right? If your articles and if there's a dispute between the regulator's rule, that's the central bank rule, and the articles, you have to give priority for the central bank rule, because the more responsibility goes to the depositors, not to the shareholders. Now, for an example, your company articles might say that the shareholder can hold for 20%. But the central bank says, no, you can go, individual can go up to only maximum 10%. Anything above, that's only up to 15 with the consent of the finance minister or the monetary board. So there are provisions in the Companies Act to say that you can go hold even 50%, but regulator will say, no, there's a restriction. So at that time, you can't follow the articles, you have to follow the regulator. And if you see the company law, it says a director when he is arriving at 70 years, he has to move out, but that section 210 says a director who is at the age of 70 must move out, but 211 says with the consent of the shareholders he can continue. So there are provisions in the Companies Act for a director to continue even after 70. But the regulator's corporate governance says, no, a director can be there only up to 70. As soon as he arrive at 70, automatically his position will be automatic. He will cease automatically. Right? And at the same time, the Companies Act will say a director can stay for any number of years, no restriction. If he has joined at 21, he can stay till 70. But the Companies Act the regulator says, the central bank says, if you're a director of a bank, maximum you can stay for 9 years if you're a non-executive director. For an executive director, that rule is not there. So either maximum 9 years or 70-year rule. So you can see how this regulator is putting a lot of restrictions or controls to protect depositors' interest. I can remember this when the rules were introduced in 2007. Central bank had a lot of issues. Now they wanted to introduce this corporate governance. Actually, most of these corporate governance principles were introduced along with this Mr. Ceylon Bank, who is his name, Mr. Kotalawala and his team. So at that time, Golden Key and the Selinco Group and the Ceylon Bank was under one umbrella. So Golden Key crashed. Selinco Group had a lot of problems. So at that time, unfortunately, people thought now it's going to affect the Ceylon Bank as well. So then the people started withdrawing money. Luckily, the regulator took a decision. They removed the entire board, Ceylon Bank board, and they appointed a group of independent people. Because of that, their correct decision, today the Ceylon Bank is surviving. So that is a good decision. So they thought, okay, now the Golden Key is crashing because these all were under one umbrella. But there was no big impact for the Ceylon Bank. There were certain issues, but it was not dangerous as Golden Key. Okay. So then they wanted to introduce, along with that, they introduced this 9-year rule. They introduced this 70-year rule. And there were a lot of objection from the banking sector itself. Why you want to change this rule? We are doing well, other banks. So at that time, the central bank argument was, no, we are here to protect the depositor. We have no issue with regard to the Companies Act. We have no objection. But if you analyze your balance sheet, your assets, your liabilities, you are more responsible for the depositors, not for the shareholders. We are there to protect the depositors, not the shareholders. So along with that argument, this corporate governance rules were introduced, and those are very stringent type of rules, but banks must adhere and ensure that all these corporate governance rules are met by the company. So that is why if you see your annual report, you can see that you have a corporate governance code, whether complied or not, a separate corporate governance code or a statement. And since you are a listed entity, you will have best practice code compliance. And if you are since you are a listed entity, sometimes you will have the Colombo Stock Exchange listing rules requirements. So we want to show that we have complied in line with the central bank requirements. And not only that, the central bank requirements, whether we have complied or not, the external auditors have to give a confirmation to say that we have complied or not. Because whatever the action that we take at the bank level, under corporate governance should be certified by the external auditors through a certification that we have complied everything. Okay, so that's the beauty. Then you're having a control over that also. Internally, banks must ensure that they comply all the corporate governance requirements. So theoretically, all the banks are compliant. But maybe that sometimes the banks can hide their real picture behind this box ticking exercise. So it goes with the intention of the parties who are running the business and what they really want. Corporate governance is all about good processes and how people behave. So if your behavior is bad, we can't expect good processes. If your behavior is good, if you're more concerned about your reputation, and if you're a person who take things very seriously, very positively, I think your processes will be good. So it's challenging. Internationally, we saw globally there are issues. Globally, companies have failed because of these wrong practices. But finally, it's important for all the companies to ensure they have corporate governance, because the success of the company goes with the corporate governance requirements. That's something that all of you all must understand. Any questions? Right. So it's something to do with, if you take this slide, it's something to do with the processes, how you run the business. Day-to-day business running is the management. The running the business is management. How you run the business is corporate governance. So the board of directors are responsible for that, right? And they have to ensure that proper mechanisms are in place for them to have effective governance in the organization. So corporate governance will add economic development, increase access to finance. It will create investment, growth opportunities, employment opportunities. If you are working for a good governing company, people will prefer to work with you because they know that there are a lot of opportunities in your company. Right? There's a growth. When the organization is expanding, there it creates a lot of growth, and the retention rates will be very high. People won't go out because they know they have transparent processes and policies. So you are very happy with that, your company. Lower cost of capital and improves valuation. So now even today, yesterday, the deposit rates of the bank were 2%. But still at 2%, people come and deposit money. Whereas the finance sector companies, they are offering 4%. But still people prefer to come and deposit their money in the banks than finance companies. So it's very clear that when the governance is there, people even at a low cost, they want a comfortable place, they want a safe place to keep their money. So in order to keep that in a safe place, even the rates are low, they will come and keep their money. Improves the operational performance. It's obvious. You're talking about good practices and good processes. It will definitely improve the operational performance as well. Because for each and every step, you have a process. So whether the processes are followed by the employees is a question. Now, as all of you all know, banking sector is the only sector that we have a lot of directives, operational guidelines, policies, procedures. Now, do you all follow all these policies and procedures? Yes. Madhuranga, do you have time to follow all these policies and procedures? Yes. Dennis, do you have time to follow all these policies and procedures? Sampath?
We don't have, but the thing is, we have to follow, otherwise, there will be a problem.
Yeah. Do you have time to read all these policies and procedures? Yes.
Actually,
I don't want.
actually speaking,
I don't want an answer. I know. I can understand. So the point is, where now it's true that we have a lot of policies and procedures. That's why now, at least now, if you are working for a branch, if you can appoint one individual, a senior person, for him to read everything and to have a summary meeting at the end to say this is what you have to do, I think that's ideal. So if you have 20 people in the branch and all 20 reading the same document, I don't agree that will happen. So why not you allocate a person every month? You are the assigned person for this particular month. You have to see, it should be a senior person, not a junior, right? You are the senior or two people. You two decide what is there in the rule and explain to everyone. So then you have a snapshot of that particular code, rule, procedure for you to follow. So request them to have a format, request them what's all about, what to do, how to do, when to do, and what is the repercussion if you're not going to do it. So then you are authorizing your team every month, 2 senior officers, to handle that job and explain at a meeting. I think that would be the best, rather than requesting all 20 to read. No one will do that. So if you're the boss, better you include that in the objective settings for the year and say January, or quarterly you can allocate. If you have less team members, you quarterly say January to April, you have to do this. May to this, you have to do this. So then you're distributing your knowledge sharing, you are improving, and at the same time, you're not going to miss everything. Because if you see the directives now, one of 2016, I can remember when we were formulating this one of 2016 money laundering directive, it took more than 3 months for me to understand. Just imagine, right? To understand and put it into business sense and pushing it just to understand. And it took almost 6 months to us to finalize it. Initially, we gave the required instructions for the business to continue, but to bring a comprehensive, a detailed document for business to understand when putting into them was a real task for us. Then we started, parallelly we started conducting lectures, training sessions to give the spirit of this rule. Why we want to be very careful on this money laundering aspect. What type of things will happen if you're not going to follow? Because they wanted to bring this penalty culture, right? So just imagine, right? So it changed the entire business. All the banks had the same. Compliance officers had a huge issue passing. Then there was a lot of objection from the business to say, you are requesting us to do everything. How can we do everything? Do you want us to do business, or do you want to comply the rule? So if you are in part and parcel of the compliance, if your business recognize the compliance, I don't think that it's going to be a big challenge. It's true that you are going to 100%, but compliance is difficult. But if you put that into your business, compliance and governance should be inbuilt in your business, right? If it is inbuilt in your business, it's not going to be a challenge. So when you are trying to take this governance, compliance, and business separately, it's going to be a challenge, because the integrity is an important point. Honesty, transparency are problems. People want to bring businesses, people want to show they are performing well, and they go for illegal and unethical businesses. And as a result, finally, it can be a violation. It can be a negative uh, uh, news for the bank, and it's not good for your organization. So we, all of us, must understand, as I told you, there can be situations where some things can happen. You can't control everything, but you can minimize your damage. So best would be sharing knowledge. Right, good. So try that, what I told you to all. I think it will work definitely, and it will help you to uh, uh, ensure that you are in line with the rules and regulations as well. Will restore the bank's reputation, because as I told you, it's a reputation. Banking is all about reputation. If you are going to lose your reputation tomorrow, people will start withdrawing money. It's going to be a tough game for you to balance. No financial institution, even a giant bank, can survive if tomorrow people start withdrawing money. You will crash, because we don't keep money for all the depositors. We keep a small percentage by way of a reserve, and we are running from a roll. We take deposit, we lend, and once again recovery. We recover installments, we recover, and we give it to the depositors, whoever who want. So it's a rolling battle. Right? If all the depositors start withdrawing money, in any bank in this earth will crash. less and better manage risk. So if you have good governance in your organization, it will help risk management, well, good risk management, and the risk what you're going to take will be less because your processes are in place. You don't have to worry. Nothing will affect you, right? That's important. In particular, because of the central bank role bank plays in the economy. Well, governed banks will play a positive role in the economy, mobilizing and allocating society's savings. So you have a responsibility to take the depositors' money and protect them and return whenever they want. So it's a huge responsibility for you. You can't deviate from that. They maintain a trust, they keep a trust, and they are coming to you uh, thinking that you will protect their money. So that responsibility, that duty is much more higher than a normal duty. Providing finance to firms, in particular in most developing countries, deep equity market. So you are lending, you are accepting deposits and you are lending. That's your main responsibility. And so you have to balance it. You have to have quality lending portfolios. So I told you at the beginning, you have to understand the size of your organization. And in line with the size of the organization, only you will have to lend. Should not lend for each and every facility. You can't afford that, right? So banking business and finance company businesses are two different businesses. You should not compare, you should not compete each other. While poorly governed banks can lead to disastrous concerns. So there are crisis situations. If you just go to YouTube and if you type this, you can see how banks crashed, right? So uh, uh, rather than the other financial institutions, we have a huge responsibility to protect our depositors' interest. Internal and external controls. You get the external auditors, you get the internal auditors. Internal controls, it's the responsibility of the internal audit to ensure that you are in line with the internal controls. So as the business units, separate business units, you have to ensure that you meet the internal controls requirement. It's a part and parcel of the organization to make sure that you maintain that, right? It's important for you to have a proper system within the organization for internal controls, right? Now there are different stakeholders. So uh, it can be the shareholders. Unfortunately, the topic has skipped. 1 minute. So the stakeholders are the people around your organization, right? So each and every stakeholder will have a responsibility towards the organization. The whole idea of the stakeholders is to make sure that you protect their interest. And if you're going to look after each and every stakeholder, I think they will look after you as well. So I'm not going to go in detail on these slides. I will discuss the key important points. Corporate governance determines the allocation of authority and responsibility by which the business and affairs of the bank are carried out by its board and the senior management, including how they set bank strategy objectives, select the oversee personnel. So last session I told you there are two main responsibilities of the board. That's the performance and conformance. Performance is the responsibility the board responsibility is to ensure that you perform and you confirm. Performance, there are two sections, strategic planning and policy making, and conformance, they have two, executive monitoring and accountability. So these are the main four functions of the board, and the board must ensure that they will they create a culture conducive culture for the rest of the parties to introduce corporate governance into the country, into the company. So board should understand their responsibilities, performance as well as conformance, and run the show. The tone should come from the top. The leadership should ensure the governance in an organization. So the chairman and the board must ensure that they are examples for the rest of the organization. So if the board is corrupted, we can't expect anything from them or governance in that organization. Any organization is the same. It can be a bank or a non-financial, financial, any other business entity. So the strong governance rules will come with people. That's what I told you. The governance is all about people and how they think and how they behave. So if the thinking of the top people are in order, and if they think the future of this company and the country and the economy, they will bring value additions, right? So we want leadership to the entire world, entire country, entire organizations to bring add value to the system. We don't want individuals who are thinking on their interest, because that is short term, right? If you have done something to your organization, if you have done something to your country, and if you have done something to the world, people will prefer you, right? People will respect you. Mother Teresa is a character we people respect. Whatever the religion, whatever the race, they will respect. Mahatma Gandhi is a person who people respect, right? He has not done anything to our Sri Lanka, but we respect him because we take him as a leader. There are positive and negative things of each and every person. Always you need to take the edge. What are the positive things? So then you concentrate on those positive things and make sure, okay, they have done a good job. So at the same time, there can be negative things also, but take the positive things, right? So there are certain characters in our system we consider as good people who have done something, but you can't always talk about the history. Currently, you have to do something as well. Okay. Any questions? So most of the points in these slides I have explained at my previous sessions as well, right? So I just want to highlight certain more specific type of corporate governance to the banking sector. Basel Committee Corporate Governance Principles for Banks. So there are certain principles.
Sir,
Yeah.
sir, excuse me, sir. Can you mention that those duties of that board you mentioned, that performance and conformance?
Yeah.
Under that there are four. Can
Yeah.
you tell that those four again?
Performance, there are two functions:
Okay.
strategic planning and policy making.
Okay.
Conformance, accountability, and executive monitoring.
Okay, sir. Thank you.
Okay, so the theory says that the directors must spend 63% of their time on performance, 63% of their time on performance, and 37% of their time on conformance. That is the accepted standard by the theory. But at the same time, the article says out of this, um, uh, actually what really happens, they spend 63% on conformance, that is executive monitoring and accountability, 37% on strategic planning and policy making. So what is required and what's their performance are two different things. So as a result, they are not contributing in a big way to the companies. So what you have to understand is, if your company, if your board of directors are more focused, they spend 60% odd for performance, I think you are in the correct track. But this information are broadly highlighted by Professor Bob Tricker in his book to say this is what we expected, but this is what really happened. So then he argues and he says, if you are not in line with your job responsibilities, finally you will not be able to perform as what you expected. So if I am expecting you to do something, and if you're doing something else, how can we at the end of the year, how can we say that you have performed? Are you in line with that? No, you are not in line with that. So these are certain things that we need to understand, right? Performance and conformance are the two key responsibilities. Out of that, you have to spend 63% of your time on performance, 37% on time on your conformance, right? So there are Basel Committee corporate governance principles, right? There are altogether uh, 13 principles introduced by Basel Committee. So what I'm requesting you to see now, definitely these principles were taken into consideration by the Central Bank of Sri Lanka when they are preparing their corporate governance code. Okay, and they are preparing the corporate governance code 2007. They have taken all these points into consideration, and they have prepared. So because Basel Committee gives international instructions for the banking sector, what you have to do in line with to bring corporate governance. They're very specific and they are very particular on these areas, because it's important for a company to ensure that they bring governance, um, uh, maintain high level of governance in banking sector. So board's overall responsibilities. So principle one is on board overall responsibilities. So then give the explanation how you have to do it. Principle two, board qualifications and composition. So if you go through the corporate governance code 7 of 2011, sorry, uh, uh, 2007, is it 11 of 2007, you can see all these principles are incorporated into the corporate governance code as well, introduced by the Central Bank of Sri Lanka. But I just wanted to highlight how these Central Bank rules were introduced. Before that, it was there in the Basel Committee report. So they have taken these points into the code, into the Central Bank code, and they have published among all the banking sector. So all the banks have to fulfill these corporate governance requirements, and they expect big banks to make sure that they bring corporate governance at a high level, small banks to make sure that they meet the requirements. But when you come to the regulator, what they say is they have a little bit lenience over the small banks, and they are not expecting the small banks to comply at the same level. But the main reason what they say is the big banks are too big to fail. If a big bank is going to crash, it will impact the entire economy. That doesn't mean a small bank is going to crash, it will not impact. That will also make a negative impact, but collapse of a big bank will create a big economic situation, economic negative. And what you have to understand as bankers, if tomorrow, if a bank is going to crash in this country, it will affect all banks will crash. Though you're claiming you're number one, number two, anyone will crash, because the success of the banking sector depends on the trust. So if you lose the trust over the people, they will start withdrawing. If people start withdrawing, that's the end of the story. Central bank will not be able to control, right? What can the central bank do? Can they bring money and give you money to pay loans? Billions of deposits? No, not at all. Right? 100%, our entire economy will crash. There'll be a run over banks. Your rupee value will, your dollar will fly like nothing. People will not give, foreign countries will not give loans, right? Then there won't be any value for money, right? For you to buy a loaf of bread, you will have to pay thousands. So all these are interconnected. That is why we have to have a strong banking sector. You have to build trust. We have to comply with these rules and regulations of the banking sector, corporate governance, right? It should not be a box ticking exercise. You have to do the real expectation. Then you are strong. You know that you will, you have shocks to absorb any difficult situation. So the banking sector was able to handle this current COVID situation in a positive way, right? So it's true that the NPL ratios went up because the businesses, people who have borrowed when they are not performing, it's obvious NPL ratios will increase. But bounce back and make sure that you can survive. You are steady, you are strong, and if you can proceed, yes, that is what we want. So understand, as financial institution, employees of financial institutions or the banks, those who are expecting to join to the banking sector, right? We have a huge responsibility than other institutions because we are playing with public money. We take public money at a low rate and we are lending this public money at a higher rate, right? Right? So it's very challenging. So we are the only business we borrow. We are running at others' money. If you take a private company, they have to bring money. It's the owner's money. But banks, we don't have to bring money. We form the company with shareholders' money, and after that we keep on collecting money and we lend. So simply we are running the business with other people's money. Right? So just go through the principles which are there. I'm not going to go one by one. So all these principles are there in the corporate governance code introduced by Central Bank of Sri Lanka. Any questions? Yes, any questions? So bank both will have different committees. One is the board audit committee, risk committee. Right. Two important committees are the audit and risk. And top of that, you will have the remuneration committee and the nomination committee and related party transactions review committee. So these are 5 mandatory committees: audit, risk, nomination, HR committee, and related party transaction committee was introduced based on the listing rules. At the requirement of the listing rules, this related party transaction review committee was introduced. So all of the 4 committees were introduced from the Central Bank of Sri Lanka. So the whole idea, the subcommittees are there to assist the main board. So audit aspect, financial aspect, internal control aspect is monitored by the audit committee, and you have to have a strong audit team. You have to have a strong board of directors who are more focused on the audit function and way forward to protect the interest of the deposit. So any financials, the moving of figures here and there goes through audit committee. If you have capable, knowledgeable people in the audit committee, no one can do that. So that is why the priority one will go to the audit committee in the banking sector. Now risk committee, if you take the non-bank financial institution, they don't have audit and risk too. They will have only one, because the risk aspect is also taken into consideration by the audit committee. But the banking sector, with this 2007-2008 crisis situation, the banking sector, central banks stated, no, you have to have an independent risk committee. Risk is the second defense line, and it has to be monitored separately, and you have to have a risk officer and so many other requirements. So the whole idea of the risk committee, risk and compliance committee, is to make sure that you comply the risk requirement, you comply the compliance requirement, and you have a strong second defense line. Now, if you take the 11 of 2007 scope of the directive, principles are set out in Directive 2 should be referred for explanatory purposes and for the classification of purpose only, so as to understand the rationale for the rules as contained in Direction 3 hereof. So if you see, they have issued Direction 2 and 3. So if you compile it and see, okay, all what you have to do is clearly specified. So my advice is, rather than go and checking this 11 of 2007, you get hold of a listed bank corporate governance report, right? You can see all these requirements, and you can see how these things are behaved, how these things are monitored by the banks, and based on the monitoring aspect, you will be able to see what prominence given by each and every bank. So I think it's best time for you to understand your own organization, corporate governance code, and its behavior, right? I think up to this point, you have not discussed anything about the corporate governance when you before you start this program. Now you know the importance of corporate governance. Its corporate governance will help you to ensure that you build trust over your depositors. If you can build trust, you don't have to do a lot of marketing. You don't have to bring colorful advertisements. People know. When you say, okay, we have this product, people will come behind you. Today, what has happened, banks have to go behind the customers selling their product, bargaining their product. People bargain. Corporate customers, they bargain. They will say, look here, that bank is offering at 5%. Why can't you give at 5? So then you reduce one notch down and say it's 4.9. That is undercutting. Right? It's today, especially this current condition is worst. All the banks have excess money. That is why the deposit rates have gone down. Believe that deposit rate is 2% day before yesterday, and the FD rate 1 year is around 4.25. I think this is the lowest in the history, the last so many years. So we are we are facing a challenging situation. At top of that, we collect deposits. We need to give lending, otherwise the organization will not grow. So it's a challenging task for all of us, but make sure that you build trust and confidence over the people. If you can build trust and confidence over the system or the people, I think that is something that you can do. Can you see the slides? Hello?
No, sir.
No, sir. Okay. Now can you see the slides?
Yeah, now can, yes.
Yeah, okay. So these are the principles that was introduced under the 11 of 2007. Responsibilities of the board composition, criteria to assess the fitness and propriety of the directors, management functions delegated by the board, the chairman and the chief executive officer, board appointed committees, related party transactions, disclosures, right? So all these are requirements under the corporate governance for the banking sector, right? So the bank must ensure that they comply all these requirements. So I have highlighted each and every point and given the requirement what to do, right? And all these slides are in line with that, each and every area what is expected by the regulator. So the point what you have to understand is there are expectations of the regulator. Up to what level you are doing is the challenge. Okay, whether you are doing 100% or whether you are doing 90%, whether you are doing 10%, and you still tick the box and say, yes, we are doing it. We have done that. Right? So it's very challenging from the regulator point of view. It's very difficult for the regulator to understand what you have done is right or wrong. At the same time, the regulator also must be very practical, because now if you see the current condition, uh, it's very difficult for you to perform while at office. Now, if you take me last week, uh, we had to function from 3 locations. Out of I have 14 team members, only 5 reported to the head office, 3 reported to our Borella branch. We have a unit, separate unit there, and the balance was reported from home. So the whole idea why I want to distribute that, in case if something happens to one team, there are any given time there are 2 teams. If something happens to 2 teams, there is another team. So I used to go every day to office, and there are few others who are coming, only 5 out of 14. So the distance is massive. We maintain the distance, but things are moving in a way that it is manageable for us. But it's very difficult for any organization to expect 100% contribution, because everyone is not working at the same platform. If you're, especially when you're working from home, I don't think the productivity will be very high. Right? For me, my productivity from home is very low. That's why I'm taking a risk. I'm going to office, because I know that if I'm working at home or from office, I can give the maximum, because when you are at home, we don't feel it, because we have working inside the office environment for a long period. Now it's very difficult for us to adjust to a work from home type of environment. That doesn't mean that we can't work, we can do it, but I prefer to go out and go to the office and work, because as far as we maintain the distancing and as far as we can maintain the requirement, I think there's no risk. If you're overcrowded, if something happens to a team, then everyone will be affected. So that is the spirit that we have to understand, and that from the regulator's point of view, they also must understand that we are running this business at a tough time. So we can't expect the same level of governance what we expected 2 years back, because it's not possible to give that level, no? So some flexibility should come from the regulator as well, and they have to think a little bit differently. So if you are going to go for this small magnitude type of thing, micromanagement type of thing, I don't think that's the spirit of this governance. Okay. Responsibility of the board. What board has to do? The board must focus on the following 2 responsibilities. In line with the directions: the management of the affairs of the bank, conduct of business and maintenance of prudent risk management mechanism, told from the top, the safety and soundness of the bank. So the corporate governance directive says these are the 2 main functions: management, safety and soundness of the bank. So how you are going to do is your call. The regulator is not going to say that this is how you have to do it, because the regulator can't simply say that. Right? Regulator, because finally you have to see how you're going to do depending on the size of your bank. Right? One standard will not fix all the banks. It's the bank will have to take the decision how we are going to apply these principles into your organization and make sure that you comply with the requirement. Right? So that's the call that you all have to take from your organization point of view. The board of directors must periodically assess effectiveness of the board own governance practices, meet regularly with the key management persons, KMPs, to review policies and monitor progress towards corporate objectives, implement communications policies for the bank with the stakeholders, including depositors, creditors, regulators, customers, and shareholders. So all these principles come from the corporate governance, CPSL corporate governance. So we have to have this. We have to comply with that. You can't say that we can't do it. We have to do it. If you're talking about quality banking, if you're talking about trust, building trust among the corporate, our investors, our depositors. You have to bring all these requirements. That is why the central bank has carefully studied the requirements and they have passed this. So whether there's a question whether the corporate governance code, which is there 2007, whether it's outdated. Now almost 14 years have gone, no big change. So I think the central bank is working on that to bring a new code. And even they wanted to change this banking act effective from this year. But unfortunately, because of the COVID, they couldn't do that. But we have to be, it's very alarming if they introduce the new banking act. I can remember in 2019, no, 18, the director bank supervision was, it went headlines as well at a symposium, compliance symposium. He was telling, today we are barking, we don't have teeth to bite you. But when the new company, when the new banking act comes, we are going to bite you. So today we have the banking act rules are there, but they can't enforce penalties. They can't fight us. What they can do is only bark. Once they come, they will go through your weaknesses and they highlight in a piece of paper and they will send you to rectify. No penalties enforced. But when the new banking act comes, straight away they are going to have a charge sheet. Along with the weaknesses, they are going to send the charge sheet. So first you have to pay the penalty and then only you will be able to correct that. Today, only the correction, no penalties. But when the new banking act comes, first you have to pay the penalty and subsequently you can correct it. So the risk-based approach they want to introduce, what they say is the banks are negligent. You have to deal in line with the size of your organization and you have to bring strong principles for your organization and make sure you build trust. So people are a little bit lenient when they say, okay, we want to achieve targets. Now everyone is going behind numbers. We have limited customers, huge competition, undercutting is there. Transferring of facilities from this bank to other bank is there today, right? Because everyone wants to get the customers into their boat. And as a result, sometimes this unethical practices will be there as also. So all of us must, as a sector, must understand, though we are competing maybe, but we should not undercut each other. Any bank, if tomorrow X bank is going to crash, it will impact the entire banking sector. No one will be able to survive in this economic conditions. Everyone will crash. The message will go, X bank crash, tomorrow Y bank is going to crash. People start withdrawing money from the Y bank. When the Y bank, X bank and Y bank crash, why not Z bank? People will create arguments within the society and they will, all the entire banking sector will crash. So it's the responsibility between you and me to ensure that looking after this, we have to look after the interest of the depositors, lenders, shareholders, customers, employees, and protect this industry. So there are different meetings. They say minimum 1 meeting per month, board meetings. So you can have any number, but minimum 1 meeting. Frequent meetings should be there. So directors will have meetings for them to take decisions. It's very important to meetings only they can take decisions. I think there are those who know about the banking, what do you call it? Alison must experiencing this type of meetings. Do you all have frequent meeting, Alison?
We have meetings, but now it's all
online.
Yeah.
Yeah. So when before the meeting, you might have a lot of work finalizing the agenda. With definitely the company secretary must be doing that, but still coordinating with the chairman and sending the documents, to ensure that everything is up to the requirement, or it's your responsibility, no?
Yes, and most of those are uploaded to the board pack, so they have direct access.
Okay, so hard copy system is not there. That's a one important transition. Earlier banks used to distribute hard copies of the board papers to the directors. Now hardly you get these hard copies, right? Even for hard copies, we used to take e-forms. Even the regulators also accept that. So it's a good time to reduce this unwanted wastage, right? Not the savings part. Finally, it's you're collecting garbage, no? So we all have to be understand that also. If you have a system where you can scan it and archive, that's more than enough. So here we are talking about 6 years, keeping everything for 6 years. After that, there is no value on those documents because even the uh, uh, court will not ask for you. If you're going to say our normal we keep only for 6 years, that is accepted, right? So that's how it goes. So most of the transition took place because of this COVID. Though COVID is not so positive thing, but still there were a lot of positive things out of COVID as well. Board composition, you will have to have a number of directors of a board should be between 7 to 13. So out of that, one third should be executive directors. That's a maximum, right? Directors limited for 9 years, and other than the who is also CEO is acting as an executive director. This will not apply for executive directors, but others maximum tenure will be 9 years, right? So you can see how things are have introduced by the law. Independent directors, we call them as independent because its independence is decided from criteria, and so there is a defined criteria by the central bank. There's a defined criteria from the stock exchange. So any person who is falling under that particular criteria, we consider as independent. So the stock exchange rules will say, okay, what is the minimum independency? The whole idea of independent directors is to make sure that they act independently. They look for the best interests of the company, right? So they are not biased. So independent directors' responsibility is to add value for the organization and build confidence over the people. Now, if you take this diagram, you can see this circle and the triangle. Triangle denotes the hierarchy, your organization hierarchy. You have the managing director or CEO, then you have the second layer, third layer, fourth layer. Circle denotes your board of directors. The people, 3 directors who represent the board and the management are called the executive directors. Other 5 directors who are just representing the circle are called as non-executive directors. Out of these non-executive directors, any director who fulfills the independency criteria are considered as independent directors. Right. So, okay. So the based on the criteria given by the regulator, the bank must maintain, right? So they might say, okay, minimum you have to have this number. It's better to have this number of independent directors. So if you can have all, if you take this circle, if you can have all 5 independent directors, that's fine. But understand, independence is just a criteria. It does not give a 100% confirmation that they will take independent judgment, right? It's all about people and how they behave. But from a box ticking exercise, you will have the required people. Fitness and proprietary, and there are 2 components. You can't be there after 70, and you can't be a director more than 20 companies. So if you are a director more than 20 companies, automatically you will be seized and be taken out, right? Will not be considered as a director of that particular company, of the bank. Management function delegated by the board.
Sir,
Yeah.
Sir, excuse me, sir. In case of that independent directors, that means they have no interest with the bank. That means like shareholding. No, that's the
No.
meaning of the independent.
Yeah, they don't have any relationship with the bank. They don't have any shareholding in the sense now they might hold 100 shares or they might hold 1,000 shares. What is the impact that they can do by holding 1,000 shares? But if they're holding 1%, 2%, or 3% of the company shares, they can create a holding. So here, best would be not to have a single share. But still, though you have shares up to a considerable amount, that doesn't mean that you will lose your independency. But if you're holding anything about a substantial amount, they talk about a substantial interest, that is 10%. If you're holding 10% or more, you will lose your independence. Or if you're holding more than 1%, you will lose your independency. So the criteria I will say with regard to the shareholding, best would be not to hold anything. So as I told you, it depends whether sometimes you will not hold a single share, but sometimes you will not act as an independent person. Person who is holding 5% of the shares might act as an independent director. So it's all about the behavior, right? It's not the box ticking exercise, but we have to understand it's how the people behave. So it's very challenging, I would say, to see whether the directors are really performing well, independently perform. So it comes with your culture. If you have a clear culture background and if your people are much more responsible and if they have a reputation and they don't want to fail and they are too big to fail and they fear to fail, yes, they will bring governance. So I think that is the culture that we have to introduce into our system, not to just to tick the box and say, okay, we have done this governance. So when you come to delegation of powers, board, there are certain functions that they should not delegate. So
Sir,
yeah.
sir, excuse me, sir. Then there's another one that 70% age that's applicable for CEOs also, chief executive officer also, or only for directors?
Only for the non-executive directors.
Not applicable to others.
No, no, no. 9-year rule will not. Sorry. No,
70 years.
70 rule will apply for executive directors, but the 9-year rule will not apply for executive directors.
Executive means including chief executive officer.
Chief executive means anyone who is sitting in this triangle and the circle. The top person in the triangle. So if you see in this diagram, you get 3 executive directors. Out of
Yeah.
these 3, the top person is the CEO or the managing director. So for these 3, 9-year rule will not apply. For this 5, 9-year rule will apply. Right? But the 70-year rule, if I'm not mistaken, because the point is where normally the banking sector, there is a retirement age for them. Maximum 55 or 60. So normally the CEO, you can't see any CEO is holding 70 years. Right? So I have not come across with executives who are holding this 70-year because automatically they will be taken out by the age of 60. Right? So impliedly, the CEOs also will not stay for more than 70. They will have to retire by the age of 55 or 57 or 60. So I have not seen any executive in the banking sector, local banking sector, who goes beyond 70 years. Right? It's applicable for all the directors. Sorry, 70 applicable for all the directors, irrespective of executive or non-executive. It applies for all the directors. Sorry, I missed that point because there was one gentleman in our board who was an executive director. Earlier, he was a group financial officer. He was an executive director at the age of 70. He had to retire it. Yes, sorry, I missed that. So the 70-year rule will applicable for executive, non-executive. 9-year rule will applicable only for the non-executives. It will not applicable for executive directors. Okay.
Okay, sir. Thank you.
So I told you these are the, sorry. Chairman and CEO should be two different individuals. So if you take all the banking sector, you get chairman and CEO. So there has to be a demarcation of authority. We'll have to have a list of authority for CEO, list of authority for the MD as well, and plus, so it's stated here. And you have the board appointed committees. I told you, explain you, audit, HR, nomination, and risk are four mandatory committees. And top of that, based on the listing rules, you will have to have the related party transaction report committee, or anything else that you think, okay, we have to have committees, you can have subcommittees. That's not a problem. There's no restriction. You can have a shareholder relations committee, you can have marketing committee, you can have treasury committee. So you have to give priority what type of committee is required. So the freedom is there for the companies to decide. Freedom is there for the banks to decide what type of committee is required for them. So this related party transactions, once again, it's a little bit tough type of a game. But the theory says you are not supposed to use your relationship to get benefits, right? And for an example, if I'm a KMP, if I'm using my authority to get a facility for my spouse, it's related party transaction. So the related parties transaction you can't give any favorable treatment for the related parties. That's the whole restriction. So you have to have a separate committee who monitors these related parties, and especially if you're a director, if you're giving an accommodation for a director, you have to put it to the board. 2/3 majority must decide whether that particular facility, before you grant the facility, you have to get the approval from the 2/3 majority. So that's a requirement. Principle, there are certain disclosure requirements. Efficacy of the internal controls, compliance with corporate governance. If you see the annual report, you can see these reports are there, right? Internal controls, auditors must give a confirmation of their uh, efficacy of the internal controls mechanism, compliance with corporate governance rules. The board shall ensure that the following minimum disclosures are made in the annual report. Report by the board on the internal control mechanism, report on the compliance with the regulations and prudential requirements. So under section 2.8, if you see the banks they have complied with certain rules and regulations or disclosures, and it's a mandatory requirement for them to ensure that they publish the required reports. So this is a corporate governance structure of the bank. You get the shareholders at the top, right? Then you get the board of directors. So this was discussed, a similar structure was discussed in my first set of slides, organization structure. Then you get under the board, you will get the management. To support the board, you will have the committees. There are certain positions that directly report to the board. The company secretaries directly report into the board. Chief internal auditor report to the audit committee. The group compliance officer and group risk officer report to the risk committee, right? So similarly, there are certain independent positions which are reporting to the board and to the committees to ensure that for them to ensure their independency. So that's important. Underline the causes for corporate scandals. The dominating shareholders, a company dances to the will of the dominant shareholders. Shows nothing but the tragic fate of everyone concerned with the company, including the majority shareholders themselves. The weak role of the minority shareholders. Get up, stand up for your rights. Get up, stand up, don't give up your fight. Bank governance, politicians is a cloak. Once you have worn it, no one can affect you. Auditing, every penny in the company has an owner who has the right to know the fate of that penny. The directors board. When the director board consists of family members, the company affairs become family affairs, right? So all these principles were common for a bank, for a country, for the world. Recommendation to control scandals, eliminating political influence. So political influence is the biggest issue. Empowering minority shareholders, increasing board performance, pursuing independence of auditing process, enhancing disclosure and transparency, making the court proceedings speedy and less timely consuming. So these are some recommendations to make sure that you bring to reduce or to control company collapses. And top of that, all these are important for bank collapses as well. So these are the set of slides that is I want to discuss with you all with regard to the corporate governance of banking sector. And I discussed the corporate customers requirements and generally the banking sector, generally the corporate governance sector. Okay, any questions?
So small question, just to to get the idea. In case now, if it's a we'll say a group of companies, if a CEO of one company like a subsidiary gets a loan from like a facility from a other subsidiary, does it go to the related party transaction committee?
It should go to the related party transaction committee of that company, subsidiary company. If
Yeah,
you do, yeah. So
company where the facility is taken.
Company where the facility is taken. If it is a bank, is a subsidiary, and if the bank has given a facility to another subsidiary CEO or a managing director, it has to. So the requirement is where that company must have a requirement of identifying the related party transactions. Now, if you're talking about private two companies or public unlisted companies, or then you don't have to worry because there is no requirement for public unlisted or private companies to sorry to monitor the related party transactions. But if you are a listed entity, yes, there's a requirement because the related party transaction review committee requirement was introduced by the stock exchange. Top of that, if you are in the banking sector, you have to have an effective related party transaction monitoring committee. Especially the bank must have a process. If you are giving a facility to a subsidiary, or if you are giving a facility to a subsidiary director, right? And then you have to consider it as a related party, and you have to ensure there are no favorable treatment. Okay, so
Okay.
if you're talking about a bank and bank giving a facility to a subsidiary, yes, you have to monitor. Or if you're giving a facility to a subsidiary managing director, yes, you have to have a mechanism to monitor this related party transaction.
Okay,
Yes.
thank you, sir.
Okay, any other questions? Yes, any other questions? Okay, then initially these are the topics that I want to discuss. So there are two other sessions, but from next week onwards there will be another new session that which will start. I will come on a later stage and I will explain the rest of the two topics, which are a little bit interconnected and a little bit important topics, but those are not directly linked to this. Along with that, I will see whether I can share the assignment. And don't worry about the assignments. What is more important for you all to continuously participate for the lectures and get the knowledge. If you have the knowledge, the getting through this examination is nothing. So my request, don't get the enrollment just to get the certificate and for you to get the promotion. There are students who have enrolled for this course is to get the certificate and get the marks for their promotions. I think that you can go for that, no problem, but at the same time participate for these lectures and ask questions. Interaction is much more important, and clear all your doubts what you have. and get the knowledge also, because this is a good forum for you to understand and study the gather knowledge. Because don't miss this opportunity, because this is an excellent opportunity for you to learn new principles which you have not heard previously. So try to get the maximum out of that. Okay, then, thank you very much. Be safe, because we are exposed to the front as frontliners, and it's your responsibility to make sure that you are not, while working, while doing your responsibilities, um, make sure that you don't get exposed, and because it's deadly type of a virus, and now the things are very worst, and so be careful on that. Be safe and take all the precautionary actions wherever possible. Okay, thank you.